central bank policy, particularly with regard to the Fed, is very, very binary. They either cut or not.
They don't need to wait for inflation to come all the way back down to 2% to actually start cutting rates. We just need to be confident that things are evolving in the right direction.
They're kind of trying to tell us that we're on a path to get to rate cuts now. Inflation has come down enough that they think that they can be cutting interest rates.
We can still get 3 rate cuts despite some of the hotter inflation data.
They're trying to play the waiting game. Eventually, they're going to have to suppress the front end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 positive by a third of 1%. 3 very mild days of losses behind us. Let's see if we've got a day of gains in front of us. In front of us this hour, expect plenty of updates regarding the Baltimore bridge collapse. Lisa, finding out just how bad it was and how much worse it could have been.
Especially if we hadn't gotten that Mayday call from the ship that prevented more cars from entering the bridge. Honestly, I was watching the video on repeat last night. And again, the question just remains, how could a bridge just collapse like a couple of toothpicks? That's what it looked like in the imagery. What else are the vulnerabilities that we have out there, and how long is it going to take to work through all of this?
In a matter of seconds as well, Bramo. Just absolutely stunning pictures for us all. I think the team here at Bloomberg still tracking the disruption. AMH working through 2.5 million tons of coal, cars made by GM, Ford, lumber. The list just goes on and on.
Yeah, when you think about this port, it is what they would call a second-tier port. But because of where it's located, it is incredibly important for cars. It's inland. It's close to all these railroads. Think about all these cars going to, say, Detroit. And then when you think of agricultural manufacturing, trains that can go to Chicago, and then, of course, an export for coal. Everyone is working through what this means, but Anna Wong of Bloomberg Economics says 0.2 percentage points potentially could be a base case higher for inflation, given the disruptions at this port. And Pete Buttigieg and officials are saying this is going to take a lot of time and it's going to take a ton of money.
To me, it's also this sort of another test on top of tests of what happens when you start to reduce some of the capacity. How much do you get clogged up ports in New York, in New Jersey, in Virginia, if you do get that sort of redirected traffic? Is this sort of a much smaller scale pandemic type supply side disruption 2.0, or is this something that's completely different on a much lesser scale?
Kelly Lyons is going to break down some of the headlines for us on the ground in Baltimore in about 10 minutes' time. I want to turn to financial markets just briefly. One currency pair jumps out this morning. It's dollar yen. Let's talk about some levels in dollar yen. So October 2022, we're talking about 151.95. Japan intervenes. Overnight, 151.97 on dollar yen. Bramo, and this is what happens literally hours later. A meeting between the finance ministry, the Bank of Japan, and the Financial Services Agency. And the headline coming from a top currency official in the finance ministry is, we will take appropriate action against excessive moves. We maintain the readiness to act as usual. And a 4% move in 2 weeks is just not moderate. Now, that's the verbal intervention. We've heard that 3 times now, twice today, once in the last week. Is that going to be enough to move this currency market?
The answer is in the currency market right now, not yet. It feels like traders are thumbing their nose at the Bank of Japan right now and saying, really, this is all you've got? You're getting a little bit of a retracement of some of the weakness, but still we're close to the 34-year lows that we really hit overnight. You have one Bank of Japan member coming out and saying that the central bank must proceed slowly and steadily toward normalizing its ultra-loose policy. That's what triggered this. And then authorities come out, we'll take really serious actions. We have no idea what those actions are, and they haven't really shown a willingness to flood the zone in the past couple of months.
You go from negative rates to zero. It's your first hike since 2007, 17 years. And then you come out and start complaining about speculative moves behind a weak Japanese yen. Is it really just speculative moves behind a weak Japanese yen?
I'm not to say. They can speculate all they want about the speculative moves. I think a lot of people are looking at this and saying you've got inflation that's really coming back in Japan for the first time in a very long time, and you've got otherwise very easy monetary policy. Put those two things together, the currency move is pretty obvious. So, call it speculative, call it whatever you want. How they're going to address it really is the issue.
That verbal intervention, this is what it's worth. 151.33. We're negative on the session by 0.1%. That's how much things have moved off the back of some of that chat. We'll pick up on that in just a moment. The broader market looks like this. Equity futures on the S&P 500 shaping up as follows. Futures at the moment positive by 0.4%. Yields basically unchanged on a 10-year at 423.76, and the euro going absolutely nowhere. Euro dollar 108.27. Coming up this hour, Marvin Lowe of State Street as the rally takes a pause for a third straight day. Bloomberg's Brendan Murray on the Baltimore bridge collapse, and Bruce Kassman of JP Morgan on America's rising debt pile. We begin with our top story in this market. The equity market rally stalling for a third consecutive day, ahead of comments from Chairman Powell and core PCE to round out the week. Marvin Lowe of State Street saying this: we will see rate cuts starting in June. Most will be justified based on falling economic activity. The Fed is still an outlier given growth and inflation performance to date, but it's clear that there is a fairly high hurdle for the Fed not to start the cutting cycle. Marvin Lowe joins us now for more. Marvin, good morning to you.
Morning.
Just how low is that bar for that first cut from this Federal Reserve?
You know what? They want to cut. It's pretty low, kind of just based on where data is and probably what they should be saying around that data, but for the most part saying they're going to ignore the data. So they want to cut. There's an election cycle that kind of gets into play with this, and they still firmly believe that policy is restrictive. To me, it's a function of how much they can cut, and I think even though they pulled back on their expectations, they might be surprised how sticky inflation is.
It doesn't really matter what they say. We've just had this equity market rip.
Yeah.
5 consecutive months of it. We've heard the complaints. RBC has talked about it being stretched. Evercore yesterday on this programme called it exuberance. I think Academy, Peter Cheer was talking about taking out downside protection. Why do you think now isn't the time to fade this strength?
You know what? Because we've got a lot of central banks that are lining up for really the start of releasing the hounds, if you will. If you kind of think about a market that's expecting 3 or 4 very large central banks to start cutting in June, and then the modal aspect of that where you get these quarterly expectations for, the next year to year and a half, all of a sudden you've got several hundred basis points of cuts in portfolios that are all going to benefit from that.
Marvin, yesterday's trading action did remind me of Peter Scheer's conversation, and it's something that he may or may not have pinged me on and said, see, this is exactly what I was talking about, a thin liquidity kind of moment. Yeah. The fact that you could see a sort of sell-off into the close in a sort of unprovoked way. How do you trade around a lack of conviction and really thin liquidity with the appearance of trades leading to sudden moves for no reason?
Yeah, I mean, it certainly is a challenge. If you're in that world, certainly taking protection around is how you approach it. I'm more of a intermediate long-term investor. I look for fair value, and I ultimately just sit through it and expect kind of that story to play out. We are going to see several hundred basis points of cuts around the world over the course of the next 6 months. We do have liquidity that's still fairly robust making its way into the system. And we've got the Fed talking about slowing down QT at a time when reserves are still quite high. All of that to me is still a relatively positive story for risk assets.
Do you add then to risk assets? Do you say, OK, it's time to lean in even further because it's unclear what could potentially disrupt this?
I wouldn't be leaning in heavily. I'm more, for the most part, we've all added to our portfolios over the course of the last 6 to 9 months, hopefully. And that's put us in a fairly positive position. I think I'm looking for potential changes to get my portfolio into a better position, if you will, up in quality if we're talking about credit, potentially looking at parts of the growth equity story that get me more comfortable, but adding aggressively in here is hard. I'll admit to that.
Let's talk about verbal intervention. Started the week with it from Japan. Yeah. It continues today and overnight this morning. We get more comments. They're going to take appropriate action against excessive moves, they say. Dollar yen is still through 150. For you in this market, when you hear words like this, what does it mean?
You know what? It's a bit of a paper tiger, ultimately. They laid the groundwork in terms of how to think about their policy when they dovishly hiked to zero. The rate differentials around the world still remain fairly robust. I think when you have a very low volatility world that we do in FX, and we're always looking for the carry trade, you've got another potential funder that, since they've taken out kind of that big gap from the perspective of if they actually aggressively approach policy, which they didn't.
Do you think that it was a mistake then that they insinuated that financial conditions were going to remain easy?
I don't think they needed to. Ultimately. And I think that they probably should have gotten more clarity in their mind in terms of when the cutting cycle was going to begin. They waited for so long, ultimately. If they hiked while everyone else was cutting, it would certainly make the interest rate differential story a bit easier. I guess hindsight being 2020, I don't think they need to be as dovish as they are.
Do you think the story is specific to what's going on at the BOJ or also what we're seeing from the Fed?
The Fed is a story that every central bank follows. The Fed is a story, for better or worse, given kind of how the dollar's role is in the capital markets, is important in that discussion. So, yeah, it's twofold for sure.
At this point, we were talking a lot yesterday about the potential for ongoing Fed intervention to offset some of the bills for the U.S. government.
Yeah.
And this raised questions about a longer-term weakening in the dollar, especially as people realize, OK, the U.S. is going to try to inflate its way out of its debt issues. How much do you see that as a long-term trend that you could actually bet on?
Yeah, I think that overall term premiums are too low in the market. I think that you've got a lot of things coming together, whether it's the debt level, whether it's the amount of bills, and whether or not kind of the Fed could get to its 2% inflation target. Inflation volatility and all of those aspects equal some challenges at the long end of the curve. So really thinking about bear steepeners later in the cycle is something that I've been spending time on.
To put this whole conversation together, how much are we looking at a moment where bonds are the risk asset and stocks are actually a haven, in the sense that they're more hedged to the growth and the potential stimulus that's coming from all sides, whether it's fiscal or whether it's monetary?
Yeah, for sure. Earnings are nominal, and if we were to kind of break down the market, the U.S. growth aspects remain the strongest in the world.
Marvin, one other final thought on the events of yesterday, if we can. If you sever an artery in global supply chains, no matter how small it might be, relatively speaking, it can have global consequences. Given the challenges to goods disinflation in America, what was your reaction to what happened yesterday in Baltimore?
Ultimately, I rely on your reporters and your folks to kind of get me educated on this for sure. But it doesn't make it easier. At a time when the Fed needs to see the continuation of these disinflationary trends that somehow took a pause over the last couple of months make their way back in the market. They've got some hard decisions to make in the next couple of months, and this doesn't make it easier.
We'll see how big the challenge might be. Marvin, thank you, sir. It's fantastic to catch up. Marvin Lowe there of State Street. If you are just joining us, Lisa, equity futures right now at the S&P near session highs. We're positive a third of 1%.
Let's get you caught up on some stories elsewhere this morning. The search and rescue operation after the collapse of the Francis Scott Key Bridge in Baltimore is now a search and recovery mission. A road crew was working on the bridge at the time of the collapse. 2 people were rescued. 6 remain unaccounted for. The area remains closed to traffic, cutting off a major artery around the city. Japan has stepped closer to currency intervention, as we were just talking about. The country's finance minister ramped up hints of possible action, maybe, after the yen touched its lowest level versus the dollar in 34 years. Policymakers, they were kind of running out of choices short of purchasing the currency to prop it up after the Bank of Japan's first interest rate hike since 2007 failed to change the yen's trajectory. Shares in Chinese EV maker BYD closed the day more than 6% lower in Hong Kong after an earnings miss triggered its worst sell-off in 7 months. China's largest electric vehicle maker missed its 2023 earnings estimate by $138 million, raising questions over whether it can sustain strong profit growth amid a pretty intense price war. The company almost tripled its final dividend payment, but that was not enough to allay investor concerns. And that is your Bloomberg brief, John. Honestly, to me, it raises this question whether the whole EV trend, regardless of the region, really is under pressure in many ways under their own doing with a price war, but also just with respect to demand.
I was thinking the same thing. This is supposedly the market leader.
Exactly.
Also included in the race to the bottom for these names. This is a massive struggle in this space.
And it really bodes maybe a little bit ominously about how close people are getting to questioning whether this is truly the next step and how quickly we can get there.
More on that story a little bit later. We'll be catching up with officials from VW and Nissan as well. Up next on this program, Biden vowing federal support for Baltimore.
I told them we're going to send all the federal resources they need as we respond to this emergency. And I mean all the federal resources. And we're going to rebuild that port together.
That conversation up next, live from New York City this morning. Good morning. Trying to bounce following 3 days of very mild losses on the S&P 500. Equities up by a third of 1% in the bond market. Yields just about unchanged. Your 10-year 423.56. Under surveillance this morning, Biden vowing federal support for Baltimore.
I told them we're going to send all the federal resources they need as we respond to this emergency. And I mean all the federal resources. And we're going to rebuild that port together. Everything so far indicates that this was a terrible accident. At this time, we have no other indication, no other reason to believe there's any intentional act here.
Here's the latest. Search and rescue efforts suspended, with 6 individuals unaccounted for after the collapse of the Francis Scott Key Bridge in Baltimore. Maryland lawmakers pushing for an aid package to help rebuild the bridge, with the president saying he'd work with Congress to fund it. The collapse expected to cause weeks or possibly even months of disruptions. Bloomberg's Kelly Lyons joins us now for more. Kelly, you've been at the scene now for the last 24 hours or so. What's the latest on the ground?
Well, as you say, John, the search and rescue operation was suspended around 7:30 p.m. last night and starting at 6 a.m. today. So really just moments ago, according to Maryland authorities, the Maryland State Police, together with their partners, are beginning now the recovery efforts. This is now going to be about actually finding the bodies of these 6 unaccounted for individuals, construction workers who were on the bridge working on potholes at the time of the collapse. It really right now is an effort to try to provide closure for some of those families affected. Of course, that isn't all that will go on today. We could very well see the National Transportation Safety Board, the NTSB, actually board this vessel, the Dolly, today. They did not do so yesterday, as they didn't want to interfere with the search and rescue efforts, which were the #1 priority at that time. But they could begin the work today of the actual investigation. They're going to have a 24-person team investigating this, looking at the recorders on the ship, trying to figure out what exactly happened with this crash and what role the owner or operator may have played in any of this. And then, of course, it's going to be a matter not just of investigating, but actually trying to get the ship itself out of the harbor and start being able to clear some of the debris from the shipping containers that fell off the ship, as well as from the bridge itself, which of course is in large part submerged underwater as we speak, trying to get all of that cleared out so that the port of Baltimore can reopen. Authorities here, though, have been very reluctant to put any kind of timeline on just how long that might take.
Kaylee, in the meantime, and our thoughts are very much with the families of those 6 individuals, I am wondering, in the meantime, where traffic is being diverted, what the scene is like, what the plan is, especially given that this is a main thoroughfare, both for trucks but also for commuters.
That's absolutely right, Lisa. Roughly 35,000 commuters every day were crossing this bridge to get to where they're going. And obviously today they will not be able to do so. There was heavier traffic during rush hour last night, and today will be the first real test of morning rush hour, as these drivers will not be able to use I-695. Instead, will have to divert to other routes, including I-95, 895 as well. For commuters, that may mean more traffic on the way to work, but for transit, the actual freight that was moving over this bridge, some 49,000 commercial vehicles, or 4,900 rather, commercial vehicles use this every day as well. If it was containing hazardous material, they are not allowed to use the tunnels that go underneath Baltimore Harbor. So their transit period could be much longer. Tens of miles being added to their journeys is realistically what we are talking about here. And that is really why reconstruction of the bridge after the port is reopened and the channel has been actually cleared, reconstruction efforts are going to be key to releasing pressure in this very vital artery in terms of transit here in the Mid-Atlantic. But that is a timeline that could be incredibly long and incredibly expensive. We heard from the Transportation Secretary, Pete Buttigieg, who was here on the ground at the scene yesterday. He said this will not be quick, this will not be easy, and he said it will also not be inexpensive.
This is going to take time and a lot of money. Hey, Katie, great work over the last 24 hours. We'll catch up with you a little bit later this morning. Need to talk about global trade with our resident trade expert, Bloomberg's Brendan Murray, who joins us now for more. Brendan, let's talk about how easy it is, or not, to shift cargo to other East Coast ports. I'm thinking Boston, Miami. How straightforward is that, Brendan?
It's not a hugely complicated process, and in fact, we're already seeing ships go to ports like New Jersey, New York, Virginia, and places like Savannah. This morning, you can see those ships already gathering outside other ports that have been diverted from Baltimore. The problem comes in with each one of those containers or the shipload of commodities. They need another source of ground transportation. So that's where the complication comes in, and we're talking about thousands and thousands of containers and thousands and thousands of tons of goods and lots of cars. Baltimore is the country's busiest port for auto imports and exports, so they're going to have to find some other way to go through. Some of the car companies, we understand, have their docks on the ocean side of the now collapsed bridge, so they might not be affected. We're picking through some of those details right now, but certainly the auto industry is one of the more disrupted ones from this tragedy.
GM and Ford already saying they're rerouting to Georgia. Out of all these East Coast ports Jonathan mentioned, who is most prepared when it comes to the auto industry, given how important and critical Baltimore was for auto vehicles?
Virginia is one of the names, one of the ports that you hear talked about frequently. Brunswick, Georgia, is another one where lots of vehicles flow through. In the southeast, there are a number of European car makers have their facilities there, so that services a number of European imports and exports. So that's what we're seeing. The bigger vessels, the ones with more than 12,000 containers, some of those more southerly ports aren't deep enough to handle those big vessels, so they're going to wind up in New York, New Jersey.
Looking a little bit more broadly, how vulnerable is the entire supply chain industry right now? You see what's going on in Panama, we had the disruptions in the Red Sea, and now we have a pretty critical port on the East Coast down.
Most of the folks we talk to are cautiously optimistic that this is not going to be a huge. It's going to have a huge impact on the national economy. It will certainly affect the region from weeks, if not months. But we'll have to watch and see. We saw 10%, 20% more cargo coming into the ports of Los Angeles and Long Beach during the pandemic, and the bottlenecks, grew and grew and grew for a year or longer. So we'll have to keep an eye on whether these are just sort of isolated choke points that get resolved and ironed out pretty quickly, or whether it's sort of the domino effect that we saw just a couple years ago.
Exactly to that point, Ryan Peterson of Flexport yesterday was saying that essentially this is really the test, whether or not a sudden 10 to 20% increase in some of the volumes at places like New Jersey and New York causes the same kind of hangups. What makes people optimistic that we're not going to see those types of backlogs that were really problematic for a lot of different companies during the pandemic?
Yeah, the U.S. economy is solid right now, but it's not going gangbusters. So there is some capacity in the logistics industries that we cover, shipping and trucking and rail. There is some of these ports are running at something like 70% capacity, whereas during the pandemic they were at 100%. So there is some flex in the system to deal with this. There's also the sort of wild card in all this is the dock workers on the East Coast have a contract negotiation this year. So they're going to become very important. The workers at the East Coast ports are going to become very important to making sure these goods flow smoothly, and maybe perhaps this gives them a little bit more leverage in those talks.
Brendan, what do you think the template is, the lesson from the West Coast negotiations for what's about to happen on the East Coast?
Well, I think as I said, the dock workers, now that the spotlight is going to be on them to see if there's enough labor even to handle all these diversions. So it looks like there's a lot of big talk during negotiations like this, lots of threats coming from both sides. But it sounds like heading into the November presidential election that they can't the parties on all sides can't afford to see a strike where the East Coast ports shut down. So it sounds like they're going to try to resolve it rather than have it become yet another supply chain disruption.
Hey, Brendan, appreciate your time this morning. Thank you, sir. Brendan Murray there of Bloomberg out of London. Was reading some of Brendan's work yesterday, just the uniqueness of Baltimore's port for coal. This is what jumped off the page to me. The second largest terminal for US coal exports. And the shutdown of this, and we don't know how long it's going to go for, weeks, months, potentially hitting shipments to India. And this goes back to how we started this hour. You can get a severed artery, no matter how small, and the global implications take a while to sort of figure out the disruptions.
As people try to figure out where else is coal going to come from to places like India. Also, I was reading, what jumped out of the page to me was some of the farm equipment and construction at a time that's crucial for planting things now. This is one of the main arteries for all of the tractor trailers. Instead, to your point, there are very specific industries catered to in specific arteries, and if they get severed, how quickly can they be adjusted elsewhere, especially given some of the extra costs involved.
The coverage continues this morning on Bloomberg TV. Up next on this program, Bloomberg's End the Current as China's president looks to mend ties with American CEOs. That conversation up next. From New York City, equity futures near session highs, positive 0.4%. From New York, this is Bloomberg. Stocks near session highs. Welcome to the program. Equities up by 0.4% on the S&P. Just a few days of losses, really mild marginal snuff. Once again, when you see some outperformance, we saw this last Wednesday, didn't we? Following Chairman Powell, the outperformance starts to come from small caps. We'll see if this sticks. The Russell, Lisa, up 0.75%.
If you look at the correlation between expected rate cuts and the Russell 2000, it's getting closer and closer. It seems like people believe the smaller companies are much more leveraged to the cutting cycle and will benefit that much more from some easing.
5 months of gains on the S&P 500. A couple of days left of March. Can you believe that? Q1's finally over. You happy with that?
No, yes,
like
but it feels like it's been two quarters.
I'm with you. Feels like the first half. Doesn't it?
I mean, how many narratives have we been through? We've talked about the idea, are we data dependent or does data not matter because they're just going to cut anyway? Are we talking about a Fed or are we talking about Nvidia's cycle? Are we talking about the death of the mega caps? Or are we talking about the Magnificent Two? I mean, these are some of the narratives that have kind of percolated out with no resolution for the first quarter.
I'd say this. I think we've seen just as many narratives in this quarter as we did last year, but they're changing more quickly. So last year, for the whole month of March, it was hard landing talk, right? Regional banking issues. This time, what did that last? Couple of days, NYCB stock up and down, maybe some mutterings of hard landing, but no one really bought into it anyway.
Bear with me. It feels like people are just exhausted by it.
Sure.
And so they sort of half buy into it, don't really have any conviction, don't really trade that greatly, and then just sort of hope for some sort of shift that they can get excited about.
You're convinced everyone's bored right now.
I've heard that directly from a number of traders.
I know.
You know, look, if someone's very excited, please reach out to me, and I want to hear it, and I want to ride that excitement.
Let's get to the bond market, 2-year, 10-year, 30-year. There's nothing exciting about this. Really muted price action. We said this yesterday. It's like depths of summer price action in some places. The 10-year, 423.56. The 2-year, 459.51. If you want a bit of price action, look to Japan. Authorities all over the place. I'll give it a score and I'll get to the story in just a moment. Dollar yen, 151.16. That currency pair is negative 0.25%. That is the smallest. Teats wince. Is that what TK would say?
Yes,
Teats wince.
correct.
The tiniest bit of yen strength against the US dollar.
Because there might be intervention. They will take strong actions after seeing their currency weakened, the lowest going back 36 years. At a certain point, they have to come through with something. And how much conviction do they really have behind trying to bolster a currency when it's clear that their central bank has no interest in tightening policy materially?
Dollar yen, 151.18. Under surveillance this morning, 6 workers are presumed dead after yesterday's collapse of the Francis Scott Key Bridge in Baltimore. Authorities have yet to offer a timeline as to when operations will resume as officials look to remove debris and the cargo ship Dali from the entrance to the city's port. Businesses are diverting cargo along the east coast in the meantime. The port of Baltimore is a crucial stop for European car makers and US exports of coal as well. There's 2 dimensions to this story that I think are worth exploring right now. There are many, but here's 2. One is how much worse this could have been, and the second piece of this is liability. I remember yesterday we were all talking about this. We wanted to understand the time between the May Day call and the collision. And Governor Westmore gave us some colour on that. Basically said this, Lisa, we're thankful that between the May Day and the collapse, we had officials that were able to begin stopping the flow of traffic, which just gives you a sense of how much worse this could have been yesterday. Never mind the time it happened. I mean, you think about rush hour. This could have been seriously tragic.
I was watching the video, as I said, on repeat, which I probably shouldn't have done, but I was watching it, and I was just, every car that was going across in the 10 minutes before, I was like, don't go, don't go. And you're just so grateful that a number of them didn't go right before the collapse. At a certain point, we're talking about coverage that might go up several $1 billion for the ship, but this needs to be immediate. How do you get immediate financing to the whole region to start the reconstruction effort that took 2 years in some of the other disasters, I think in Italy, for example, in previous years? It's going to be key, and it's going to be speed that's important.
This is the liability question. Who ultimately has the liability, but how long before we have to find out the answer to that, AMH? And in between, is the president just going to offer the credit line to the federal government?
He said that yesterday. He said he has his full commitment to rebuilding this bridge and helping out this port. You also heard from a number of senators. Senator Ben Cardin as well said he does think Congress is going to step up. But Jonathan, to your point, a reporter, when the president was briefing, asked about this. It seems that a ship is at fault. Does that company have liability? And the president said that could be, but we're not going to wait around for that.
I want to turn to our next story. The latest out of Japan. Top currency officials in Japan expected to speak after the yen hit its weakest point against the dollar since 1990. A meeting earlier this morning between the BOJ, Ministry of Finance and Financial Services Agency. Risks are rising the Bank of Japan will intervene after the Japanese currency surpassed the 151.95 mark, which prompted the BOJ to step in during October of 2022. We had some comments from officials. Same official, the top currency official that spoke earlier this week. It's a repeat of what we've already heard, and we've said a million times. For verbal intervention to be credible, there has to be a policy effort behind it. It's unclear what that policy is going to look like and whether it's enough.
Especially because they keep saying we'll take bold action if needed. If it's not needed when it falls to 36-year weakness, I mean, at a certain point, where's the line in the sand? We were talking about 150 being the line in the sand. Now it's 151. So this raises questions about their credibility as they've jawboned before, and it's not clear, to your point, what the policy response is and what the trigger is to really engage it.
Apparently it's something very close to 152. That prompts the words. I'm not sure what prompts the actions.
The words.
That gets the words. We're drawing lines in the sand here. Let's turn to China. President Xi Jinping urging US CEOs to invest in China, saying the economy has not peaked. Blackstone's Stephen Schwarzman, Qualcomm CEO Cristiano Amon, reportedly among the business leaders involved in today's meeting in Beijing. The talks lasting more than an hour and a half, according to Bloomberg's reporting. Bloomberg's Enda Curran joins us now in this story for more. Enda, was this for the CEOs or was this for Xi? Which one was it?
I think it's something of a sales pitch for China. As you mentioned there, John, our colleagues in Beijing got some details in terms of what was discussed. Like you said, it went for over an hour and a half. Some Q&A. The central message from President Xi being that they welcome US investment. He doesn't see the need for the US and China to decouple. He wants cooperation. He said the survival of both nations depends on each other cooperating, by the way. And of course, this all goes to this kind of idea that China is now on a fully fledged sales pitch, given the hit to FDI over the past couple of years. It's at a 3-decade low. We know on the portfolio side, money is also leaving. So when you have the top CEOs of US companies in town, it seemed like a perfect opportunity for President Xi to meet them and try and soothe some of their fears on both the economy and on policy direction in China.
And that's China's message. We're open for business. I wonder what corporate America's message is. Do you think it's our views are independent of our governments?
Well, it's often said there is some division between where the government wants to go and where the underlying corporates want to go. But look at what the data is telling us, John. Clearly, the tension is now moving into the real economic data. FDI is at a 3-decade low. It's not that US companies or other companies are pulling wholesale out of China, but it is that sentiment is very negative. And when it comes to expanding their business, they are looking elsewhere for opportunities. And we're seeing that in the FDI data, and we're seeing it in the portfolio flows. US investors often make the point that China is uninvestable. It's not what it was. They're also putting their money where their mouth is. So there is some disconnect between commerce and the government. There always is when it comes to China. But as I would say, there's also some alignment now between the data and where the political direction is going to.
It feels like it might have been an awkward moment to have this meeting. Earlier in the week, we had the U.S. and U.K. talk about and accuse state-backed Chinese hackers of going after companies, politicians in the UK, basically scrapping voter information. And is this something that still concerns American companies? And can she actually assuage those concerns?
And we had China lodging the case at the WTO on Tuesday against US electric vehicles. This is a common recurring theme, that even when you have this kind of headline effort to stabilise relations between both governments, or stabilise relations at least on a corporate level, beneath it, the tensions continue. And to your point, Annmarie, you're talking there about the hacking allegations again, another reminder of some of the charges against China. Of course, on the flip side, you have China making this case at the WTO. That's an example of where the geoeconomic race is at the pointy end of things. It is no doubt that, broadly speaking, relations have stabilised compared to where we were, say, a year ago, around at the time of the balloon incident. Both governments weren't talking to each other. But none of these other underlying concerns have gone away. It feels like we're on timeout until we get past the US election and see who comes out of that. We know one side will be very hawkish, but of course the other side will have to probably match that in terms of hawkishness if they're to get through it. So, as I say, it feels like a timeout, but none of the other problems have really gone away.
It's getting increasingly difficult to sort of parse the politics from the economic reality in the region. And I do wonder, especially yesterday hearing about Apple, their iPhone shipments in China falling 33% in February. Is this because of increased nationalism, or is this because the Chinese economy is doing far worse than people expect and is a less fruitful place for international businesses to look to pick up some extra profits?
I think there is a sense that the go-go years are pretty much behind China's economy at the moment, Lisa. I mean, the consumer story, it's probably not as bad as the overseas perception of it is, but nonetheless, it has been more subdued than has been broadly expected. You see that in, for example, that's playing into the Apple story. Xi Jinping apparently told his CEOs that they have the economy in hand, they have the issues in hand, and that the economy has not yet peaked. But at the same time, when you speak to business people, both here and those who operate in China, they make the point that China's government appears to be very reluctant to really turn things around there and to rev things up, and that is frustrating overseas investors and those who do business there. So I think there's something of a wet blanket over China's economy at the moment. They have a very aggressive growth target of 5% this year. Obviously, that's a political target, so chances are they will do what needs to be done to meet it. But in terms of animal spirits, I think it's night and day in China's economy today compared to what it was, say, a year ago.
And Enda, you pointed to this reluctance by officials to really engage in any kind of significant stimulus. Do you have a sense of what some of the business leaders would like to see in terms of stimulus, and where sort of the wiggle room is for the Communist Party?
Well, I think people still can't push past the real estate story. Until that gets turned around, that's going to weigh on consumers, that's weighing on broader activity. It's such a multiplier in the economy. But then don't forget, people are also keeping an eye on what's happening on the manufacturing side of the economy. China is really putting in a lot of effort into the innovative and technology space there. There's a lot of concern that China is now exporting at a gangbuster rate into key sectors. Some trading rivals of China accusing them, of course, of dumping products at a cheaper rate on world markets. So even though the consumer side of things might be subdued, and of course the real estate story is very much subdued, China is pushing hard on the manufacturing and innovation space, and that is now drawing political tension around the world as well.
But are they trying to drum up that demand outside or inside China, Enda?
They're exporting surplus demand by all accounts. The suspicion and the allegation against China is that they're exporting, obviously we know the EV story, into the solar story, but they're exporting what surplus technology they have to find new markets for it. Now, of course, the countercharge from, say, business in Europe and the US is that they cannot compete with what China is doing. They're flooding the market with these key goods. And it's a non-competitive race. And that's one of the underlying tensions in this story. So, as I say, the conversation on China's economy is that it's pretty much underperforming, but don't lose sight of what's happening in the manufacturing space. There's a lot of innovation going on there. They are investing hard in technology. It is a big priority for them, and they're clearly making grounds in key sectors. And
you're one of the best. It's great to catch up with you, sir. Enda Karen there of Bloomberg on the latest between the meetings between US CEOs and Xi Jinping of China. There's one man I'd like to speak to, Mr. Schwarzman, Blackstone, sort of Trump whisperer. Get his view on China and maybe what he'd say to the former president.
Do you think that Schwarzman wanted to hear what she had to say, or do you think she wanted to hear what Mr. Schwarzman had to say? I mean, Enda's talking about exports coming out of China. The Trump campaign is talking about a 60% blanket tariff on Chinese imports if he was to get in power.
I would say this. I don't know the answer to that, but I would say this. The balance of power between US CEOs and China has shifted, given what we're seeing on FDI.
Absolutely. We're looking at, 30-year lows on foreign direct investment. This was something that Xi Jinping had to come out and had to really make a moment. He's supposed to go to the China in Davos, and he's not going there. But he made sure he met with these executives.
It's an ugly number. Let's turn to the price action. Equity futures on the S&P 500 shaping up as follows on the S&P at the moment, trying to bounce back from the mild losses of yesterday. Futures positive here, Lisa, by 0.4%.
All right, let's get you an update on stories elsewhere this morning. UBS has finalized a deal with Apollo Global Management for the carve-out of Credit Suisse's securitized product group. Apollo will purchase $8 billion in senior secured funding facilities. The deal allows UBS to close another chapter in its acquisition of Credit Suisse. price. It will book a net gain of about $300 million in the first quarter on the sale, and the private investment world will get bigger. Shares in GameStop are lower in the pre-market after the video game retailer reported plunging fourth quarter revenue. One of the original meme stocks, GameStop had seen gains following the Fed's messaging that a rate cut this year will likely be appropriate. GameStop's net sales were down 19% from a year earlier, and the shares are down about 19% in pre-market trading. A landmark agreement struck between Visa and MasterCard. Millions of U.S. merchants will see holders of luxury credit cards charged more at the checkout. The deal will allow retailers to pass on the premium charged to them for processing cards carrying the Visa Infinite or MasterCard World Elite branding. The plan is estimated to save merchants $30 billion in swipe fees over 5 years and set up a war between some of the card potential branders, because if you have one particular type of Visa, you're going to get charged a different fee than another one, and this has been the bread and butter of so many different banks.
If you've run a restaurant before, you know this story. This adds up. This is in our story today. I'll give you the numbers. A $100 transaction at a small restaurant. If a customer swipes a Visa Infinite card, that would cost the merchant $2.60 in fees. Traditional Visa rewards cards would cost just $2.10. That adds up over the year.
Massively. And you've even seen it in bodegas and things like that. Well, they'll say, if you use a card, we're going to charge you a 2%, 4% surcharge, because that's what they're being charged. This is massive. Who's going to bear the brunt of this? It's not Visa and MasterCard. It's all of the banks that are providing the base resources.
What about the airlines? Hey,
I know
there's a complaint in there somewhere.
Well, my complaint is, look, this isn't that profitable for you. Go back to the people who actually just travel and give them the upper hand.
Yes, Bramo, tell them.
And that's really the way to deal with
Focus on customer service on the airline, without
Obviously.
a doubt. Up next on this program, America's debt dilemma.
We're getting to a point where our public debt is going to start crowding out private capital, and we're going to have structurally higher interest rates.
That conversation up next.
Obviously, I'm going to different types of restaurants.
I used to live in
Bruce, how you doing?
so many places where cash.
Doing fine, thank you. How you guys doing?
I'm good, mate.
Do you have a credit card for the points, for perks, for cash
I
back?
definitely have a credit. Yep.
All of the above?
Bruce is a grounded man.
points
He's got a
mostly.
Chase Freedom card.
That's what I have.
Yeah. Entry level.
That's what I have.
Yeah. Equities right now on the S&P positive by 0.4%. In the bond market, yields just about unchanged, 423.76. There's so much going on in the land of commodities. Crude's just a small piece of it. We're down by 0.7%, $81 on WTI. We'll talk about this a little bit later, but AAA are talking about $4 pump prices this summer. That's a problem across a whole list of things.
It's a problem potentially for the goods disinflation story, and arguably, especially time-wise, it's a huge problem for the political season.
And cocoa as well, going through 10K yesterday, which I know you want to talk about.
It's crazy. I just am thinking the fact that it's actually more expensive than copper, iron ore. I mean, at this point, we're talking about a commodity. If you built a cocoa house, it would be incredibly expensive. It would be more expensive than building that entire house out of metal.
You're talking about a chocolate house?
Yeah.
Right, okay. I didn't know where you were going with that. I meant sort of like if you wanted to become a cocoa exporter. You mean like physically build a house out of...
a house out of cocoa. Like if you were going to go back to, Hansel and Gretel and try to do that.
Sure. You ever made one of those at Christmas?
I was so bad at it.
Put the candy on?
Did you ever do a good job at that?
No.
They would like fall off.
The ends would come off and stuff.
The gumdrops are always the worst.
The gumdrops
start to eat it too. All right, moving on. And the surveillance this morning. America's debt dilemma.
The cost of financing our deficits are going to erode more and more of our disposable income as a country. And I do believe we're getting to a point where our public debt is going to start crowding out private capital, and we're going to have structurally higher interest rates.
Here's the latest this morning. The BlackRock CEO, Larry Fink, in the last 24 hours, eyeing the risk of rising US debt and its impact on the Fed's fight against inflation. Fink writing to shareholders, quote, "More leaders should pay attention to America's snowballing debt. Is a debt crisis inevitable? The answer, he says, is no." Here to discuss, JP Morgan's Bruce Kasman joins us now for more. Bruce, we're going to talk about monetary policy, the Fed, the BOJ. Can we just start there on this with America's debt pile? I know you and the team at JP Morgan have talked about the boiling of the frog. Bruce, when does it start to get a little bit too hot?
Well, I think it will get too hot if we're right that the Fed just doesn't have very much room to ease. And over time, that begins to affect balance sheets. It keeps credit tight. It weighs on pricing power. It's a slow moving story. And I think we have to recognize that so far, the effects of high interest rates just haven't done nearly as much damage as we would have thought to the private sector. So this story is playing out against another narrative, which is to say the private sector is healthy. We're getting supply side improvement. Hey, maybe we can live with high interest rates and actually generate a soft landing. We've kind of moved from being very much in the boil the frog stance to being agnostic about where this story is going to lead us.
Can you talk to me, Bruce, then about the supply side narrative that the chairman seemed to endorse in the news conference last week? What's the question you have that sort of linger before fully embracing it?
Well, I think we should embrace it. There's an immigration story which is playing out right now and is boosting labor force growth. It's limiting the pressure on labor markets and inflation from rising jobs. I think we've also generated some pretty strong productivity growth, and that seemed to me to be linked with what we've been doing on spending on R&D and intellectual property. The question is, though, we still have a tight labor market. We have elevated inflation, which I think is sticky. I think, as you mentioned a minute ago, the goods price story globally is shifting here. I'm just not convinced that's going to be enough to get inflation all the way down to what will make the Fed comfortable over the next year or so.
Bruce, we've been talking a lot about the bridge collapse in Baltimore and understanding that it's just, one particular port and that potentially other ports can take in some of that traffic. But does this highlight to you that supply shocks have not gone away and that there are these vulnerabilities that will kind of put some sort of floor under this goods disinflation that we've seen for the past couple of years?
Yeah, I think what you're seeing in some senses is a little bit of that with the idea that there's some new pressures in shipping costs, and this port closure might be part of that. But also you're just losing the benefits of having unwound the dislocations. You've had over the last 6-7 months, U.S. goods pricing, ex food and energy falling at 2.5% pace. I think most of the indicators, both domestically and globally, are saying that's going back at a minimum to zero here. So when Chair Powell talks about shelter inflation coming down, I think there's an offset here of quite substantial, maybe even complete, of what's happening in the goods price story. And then that leaves the focus, of course, on inflation very much on how you think about labor markets and other service price inflation, which I think we're going to see is pretty firm when we get the PCE report on prices on Friday.
So taking a step back, this raises the question, and we were talking about it with Mohamed Al-Arian, about whether this is sort of a tipping point for this Federal Reserve in tacitly accepting a 2-point-something or a 2 to 3% inflation rate for the foreseeable future. Do you think that we have shifted, that this past press conference from the Federal Reserve was really the key moment in that transition?
I think what the Fed is telling us, it wants to start the easing process in the middle of the year, and it's willing to do so even if in the first half of this year it's getting uncomfortably high inflation performance. What I don't think this means is that the Fed is willing to accept on a sustained basis inflation close to or higher than 3%. And what we think is going to happen here is that you are going to see a pivot sometime around the middle of the year where the Fed maybe delivers 1 or 2 easing, but it really then starts to shift its guidance. The market today has over 150 basis points of Fed easing priced through the end of 25. Unless the economy gets into trouble, I don't think we're going to see that delivered.
You say they want to cut, which echoes a lot of individuals that come on the program, but they also continue to say how data dependent they are. What would they need to see in the data to actually say, you know what, we're waiting, we're not going to cut this year?
I think that's an interesting point, because as they're talking data dependent, you could see Chair Powell in his press conference really talk as if the bar is pretty high to prevent an easing. So I'm not sure I have the numbers I'd want to be confident about where that is. But I think what they've told us, at least to start the easing process around mid-year, that they're fairly comfortable they've made enough progress. Yeah, there are data prints here that could take them off of that. And I would argue the committee, as you look at the projections, are probably more evenly divided on this issue. But I think the bar is pretty high here. I'm not even sure that if we get a couple of 0.3s on core inflation, which I'd say are high numbers, that's going to be enough to prevent a June easing. I think it'll stop them from doing much, but I'm not sure it'll stop them from easing in June.
Bruce, there's one inconsistency that jumps out to me, and perhaps we should finish here. How can the Fed simultaneously say we're restrictive and then at the same time embrace the supply side narrative in the labour market, but also point to the labour market as evidence of being restrictive? How does that add up?
Well, I think there's a level issue of how tight the labor market is, and then there's an issue of how much supply side performance is helping it. But I think you are raising an important point, which is that the supply side is improving and helping the Fed, but it is also a signal that the neutral rate is higher. And I think when you look at financial market performance here, it is embedding this idea that some combination of supply side performance, a friendly Fed, and some other things going on here is allowing us to do a lot better with higher interest rates than we might have expected. So I do think you're 100% right here. Policy is not as restrictive as the Fed seems to be suggesting. I think growth will do better if we're right that inflation is sticky. I think they are going to have to change their tune somewhat here, but it still looks to us like they're getting ready to at least start an easing process around mid-year. It's
hard to disagree at the moment. Bruce, thank you, sir. Bruce Kasman of JP Morgan, going into that economic data on Friday morning. Coming up next on this programme, Katie Nixon of Northern Trust, Bloomberg's Katie Lines on the latest in Baltimore, Jeremy Papin of Nissan Americas, and Amanda Lynham of BlackRock. All of that and a whole lot more in the second hour of Bloomberg Surveillance. Up next.
It doesn't pay to be bearish, right? The data is way too good. You've got to stay bullish, and you've got to stay bullish on equities.
This is among the most record-setting periods of momentum that we've seen.
We don't have a Mag 7. We've got a couple stocks really driving it.
What we've just started to see, and I think this accelerate as we go through the year, is the rally broadens out.
We're still in a bull market, and I think you stay invested.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with your equity market on the S&P 500 positive by 0.4% on the S&P, continuing to track the fallout from the collapsed bridge in Baltimore. And Lisa, as we've said repeatedly already this morning over the last 60 minutes, just how much worse this could have been. The distance, the time between the Mayday call and the ability they had on the bridge to stop the flow of traffic, this could have been so much worse yesterday.
What a horrific event. And you're absolutely right. The idea that they were able to halt traffic did keep other cars from getting caught up in this. It does raise a question, though. How much time was there? What exactly was the cause? How long is this going to disrupt some of the traffic and some of the shipping? There's so many questions that remain. The focus right now is still on the here and after, the immediate aftermath of this. At this point, though, this is an artery that has been severed, as you put.
It could be weeks, perhaps even months before this port reopens, and then you've got to get into rebuilding the bridge AMH, that could take a long, long time and a lot of money.
It could take a long time and a ton of money. We heard politician after politician and the President of the United States yesterday say that the federal government will support the rebuilding of this bridge. It was interesting. A reporter, Jonathan, in his quick news conference said, well, shouldn't the company responsible for that ship that caused this problem? And he said, potentially, but I want to get the funds there immediately. But you have to think, Congress has struggled to pass the most basic appropriation bills. This is a divided Congress, a dwindling Republican House. How are they going to get this funding through quickly? I don't know. They're on vacation.
1977, it took 5 years to build and 141 million US dollars. This is going to cost a heck of a lot more money than that. Can we build it a lot more quickly, though?
When you take a step back, it also raises a question about the ability and willingness for the United States to invest in infrastructure and able to do it well and quickly. Yeah. This is, to me, I mean, it's sort of, this comes at a moment, horrible tragedy. It also highlights a lot of the key issues that a lot of people in markets have been talking about for a long time. There needs to be infrastructure spending. We got it. Okay, how are we going to pay for it? How do we continue it? And what infrastructure is most important to prioritize when the nuts and bolts are aging, but you also have the big tech wars that continue?
So number one question in economics, I think, following this, there are many, but I think this is probably the number one. The disinflation we've seen in goods over the last 6 months feels a little bit fragile, perhaps even some challenges to that over the last 2 months. And you wonder just how fragile it is given what's developed just yesterday.
People are speculating this itself won't necessarily materially shift the needle when it comes to some of the overall national metrics. That said, and you put it well, over the past couple of months, we already got this drumbeat of have we seen the end of disinflation in goods? This just sort of highlights how supply shocks can exacerbate that floor under some of the disinflation that we had seen.
Let's talk about some other shocks. Let's get to the currency market. Let's bring up dollar yen and take a look at what happened with dollar yen overnight. Dollar yen overnight getting very, very close to 152. So close, in fact, that Bank of Japan officials, Japanese finance ministers get together with the Financial Services Agency and start making some noise, Bramo. They have a meeting. 151.97 is not where they want dollar yen to be. They come out, they start talking about it. But that's all they do. All they do is talk about it. When are we going to see the action to do something about it?
They go get together and make some noise. I mean, that's essentially
basically what they did.
I know. So this raises this issue, which is the market basically pushing and daring Japan to do something? Are they basically saying, let's see how much you actually care? What is the line in the sand? Is this a test in a way? Because we've seen this movie before, and yet still we're hovering at 36-year weakness levels for the yen.
This is what that verbal intervention brought them. Session high, 151.97 on the screen right now. 151.18, that currency pair in the yen's favour just a little bit by 0.2%. Coming up this hour, we'll catch up with Katie Nixon of Northern Trust on how the stock rally can broaden out from here. We'll speak to Jeremy Papin of Nissan on how the automaker plans to compete in the EV market, and Amanda Lynham of BlackRock on the competition for capital. We begin with our top story in markets. Tech dragging the S&P 500 to its third straight day of losses. Katie Nixon of Northern Trust saying a broadening out could extend the rally in stocks, writing this: financial services stocks have found their footing as the outlook for interest rates appears clearer. These developments are positive signs for investors. It is clear that the market can advance beyond those large cap names in tech. Katie, I'm pleased to say, is with us around the table. Katie, good morning.
Good morning.
Let's talk about interest rates. Lisa's asked this question a million times. Do banks need higher rates or lower rates? Are you saying they just need clarity on the rate path?
I think clarity is key here, Jonathan, and it's been really interesting. It's not just clarity, but it's lower volatility in interest rates. And if you look at the MOVE index, for example, that the volatility expressed in that particular fear and greed index of the bond market has fallen substantially. And I think that just gives clarity for banks on what the environment's going to look like going forward. Lower rates certainly help. A less inverted yield curve certainly helps. But lower volatility really helps the banks.
Why do you take this as a sign, a bigger sign, that maybe this momentum, this broadening out, can continue? Why are you extrapolating out this moment beyond just the next few months?
Right. So it's not just the financial services stocks, Jonathan, but when I look across the board, the laggards have started to catch up slowly and unevenly, but they've started to catch up. So you can start in the U.S. with mid-cap stocks, mid-cap indices reaching highs. You can even look at value stocks within large cap and mid-cap starting to beat growth stocks over the short term. So that's a good sign. You can look at some of the laggards in terms of the energy sector. starting to pick up steam here. So the broadening beyond just those Mag 7, those big tech stocks, is really healthy. And then you broaden it out to looking around the world, and you can see European stocks finding their footing and starting to perform well. So I do think this broadening is a good sign of more confidence in the market rather than that sort of narrow breadth that we had in 2023.
This is such an interesting moment in markets, and I keep going back to this. I wonder how much we're seeing bonds as the risk asset, government bonds as the risk asset, and equities as actually, in some ways, the sure bet, because you got a Fed that basically is saying, we got your back, and you have an economy that continues. You've got fiscal stimulus. What's not to like? Have we gotten to this level where stocks are sort of the safety and bonds really are the risk?
I don't know if I would go that far, but I would say it's pretty hard to bet against U.S. stocks here, Lisa. And as you said, you've got sort of the macro working in your favor. You know, we've had better than a soft landing. We entered the year with a lot of positive momentum. Inflation is falling, again, albeit stutter steps, but falling. The micro picture looks better, broadening out of earnings. So we had a very narrow earnings growth in 2023 that is now broadening out. I think 8 of the sectors of the S&P are going to have positive earnings in 2024. And then you've got the policy. As you said, I wouldn't necessarily go as far maybe as to call it a Fed put at this point, but I would say it is clear that the Fed is on the path towards lowering rates in 2024. And that, again, is very supportive. And if you look at history, Fed rate cuts without a recession tend to be very good for risk assets.
Meanwhile, you have the likes of Larry Fink, but also even just government officials coming out and raising concerns about what's happening with the deficit. Do retail investors care about the deficit? Do they start asking, hey, is it a good idea to buy 10-year, 30-year bonds of the U.S. government if we think this is going to become a problem at some point in the future?
I can tell you, I think investors are starting to get concerned about the deficit. And I think that's why you are seeing potentially a setup where we just have a higher term premium down the road, right? There's a higher chance that we're going to have inflation run hotter. There's a higher chance that we're going to have these funding needs going forward in a huge supply, frankly, of treasuries that have to be absorbed. So I do think the average investor is starting to get concerned about it. We're certainly getting questions about it all the time.
Begs the question. Let me ask you one then. If I'm looking at the yield curve at the moment, I can get 460 on a 2-year, there and thereabouts. Why should I go out further along the curve to a 10-year, say, to lock in 423? What's the incentive to do that at the moment, given what you just said?
I'll tell you, though, here's the thing. So the upside here is that rates stay where they are because the economy is sort of trudging along. Inflation is coming down, maybe not as fast as we would like to see, and the Fed cuts rate. The downside, though, is that the Fed has to cut rates because we do see the economy in the second half of 2024 slowing down. Actually, we think the Fed's forecast is a little bit too bullish. So it could be a situation where rates do fall on the short end a little bit faster. And in that case, those juicy yields that you see today are just not going to be there for you when you really need them 4 or 5 years from now.
So Andrew Bowles was in the FT yesterday, right? In PIMCO, over at PIMCO, in the FT. I'll get my words out, bear with me. And he's basically saying, if I want duration risk, I'll go elsewhere for it. There are limits to the cutting cycle. I can take this exposure elsewhere, maybe in Europe. What's the argument to take it in the United States?
Well, I mean, again, you're having clarity right now on the path of rates regarding the Fed. And then you can see, again, if you look at what's happened to the 10-year Treasury, for instance, this year, Jonathan, it's been really interesting because you had a little spike as we had inflation prints come in hot. You had the Fed come in and say, nothing to see here, don't worry, bump in the road. And you had yields back off pretty quickly. And now we have the 10-year back, below our forecast range. So I think there is a lot of demand for fixed income and for treasuries right now, given the environment and the outlook. So I think you're going to see that demand come in as we see rates go up, and it's ultimately going to put a ceiling on how high rates can go.
Just to kind of put a bow on it and sort of underpinning what Andrew Bowles was getting at in his FT piece, PIMCO being cited there, how much are you looking at a higher inflation regime in the United States that is different from the regime in other countries?
Well, I think great question, and I think we heard a clue in the press conference, not in the statement, but in the press conference last week, that there is a bit of a tolerance for a longer period of higher inflation, perhaps not for a ultimate higher inflation goal, but to tolerate a longer period of higher inflation in order to maintain economic growth. sort of recognizing now that there may be a trade-off between getting inflation down to the target and maintaining economic growth and maintaining full employment. So I think there's much more of a balancing act going on now in the Fed than there was earlier. It was just fight inflation. Now it's sort of like, well, we want to get inflation down patiently, but we really want to maintain unemployment at or around 4%.
When I look at some of the equity strategies that come around higher inflation, they all point to oil. You were mentioning energy. How much is that sort of the sweet spot right now as a hedge?
Oh, Lisa, you mentioned it earlier. The supply shocks that we're seeing, many of them are around energy. We see issues in the Red Sea. We see issues in the Panama Canal. There are issues with transport and logistics now around energy. I think we're seeing now not just a soft landing here in the U.S., but we're seeing recoveries overseas. So you're going to see global demand for energy come up. So I do think it's a great place for investors to be. And, again, Jonathan, to your point about, broadening out of the market, that's an area of the market that was left for dead last year. So, again, investors should look at their portfolios and see, am I positioned for the next year, the next 5 years? Do I have my small, mid-cap? Do I have my non-U.S. exposure? Do I have my energy exposure and my inflation hedges in my portfolio? Because it is possible that we are living in a higher for longer inflation period.
Well, JP Morgan's talking about $100 a barrel of oil potentially this year. When you talk about exposure to energy across the board, or do you want to move into more of the old school energies that are picking up pace? Or are you still like maybe potentially clean energies as well?
I think it's both and at this point, and I would even expand it beyond energy to the broader commodity complex. It's been interesting to see all the attention on artificial intelligence, for example, and it's certainly driven the Mag 7. But if you sort of scratch beneath the surface, you see there are all sorts of tentacles into the commodities market, into the energy market and other commodities that are required to support the growth in AI that's getting all the attention right now. So I think for a variety of reasons, you really want broad exposure in the energy market and in the commodities market today.
Kelly, this was great. It's good to see you.
Nice to see you too.
Thank you. Kelly Nixon there of Northern Trust Wealth Management. Brent crude at the moment down by 0.7%. 85.65 on Brent. Equity futures bouncing back on the S&P 500. Slightly firmer this morning. Lisa, higher by 0.4%.
All right now let's get you an update in stories elsewhere this morning. We've been talking about this all morning. Japan stepping closer to currency intervention. Maybe. The country's finance minister ramping up hints of possible action after the yen touched its lowest level versus the dollar in 34 years. Policymakers are running out of choices short of purchasing the currency to prop it up after the Bank of Japan's first interest rate hike since 2007 failed to change the yen's trajectory. Chinese President Xi Jinping has told a group of American business leaders in Beijing he wants U.S. companies to invest in China, putting aside differences on what he said were, quote, minor issues. Xi met with leaders including Blackstone's Steven Schwarzman, Qualcomm's Cristiano Amon for more than 90 minutes. China is seeking to restore confidence in its economy, with Xi acknowledging issues with the domestic economy, but saying it hasn't yet peaked. Drug maker Altimmune could have cracked a problem which has been weighing on obesity drug makers. Patients on the latest trial of its experimental drug saw 74% of their weight loss coming from fat tissue. The company says that mirrors the results from diet and exercise programs. By comparison, trials of the active ingredient in Ozempic and Wegovy show a higher rate of lean muscle mass loss compared to fat. That's your Bloomberg brief, John.
That's a big deal.
That is a big deal.
They should call that shred. They really should. That is the ultimate dream. That's the dream thing.
100%.
That's right there. That is the dream shot.
I mean, this is one of the complaints that I heard anecdotally that people were trying to work out, and the trainers were saying to them, really? You guys can't do anything because of the Ozempic shots that were just stripping them of all their muscle. If they can shred, Operation Shred.
There you go.
I mean.
Did you watch the Oprah special?
I actually went back and watched a little bit of it.
The
It was
correlation
fascinating.
between lean muscle mass and longevity is a real deal. So this is a big issue. Reminds me of another story, actually. You see this one at the ECB.
Which one?
Olive oil. This story is the funniest story ever from Politico. There was a staff mutiny over the quality of olive oil served at the European Central Bank.
I love that.
You seen this?
Oh, my God. No,
In
I
the
have to look
canteen,
it up.
narrowly avoided after in-house caterers acquiesced to demands to bring back extra virgin options to the table. It looks like on the internal message board, the Italians were going after the Germans.
You're so proud
in
of him.
Frankfurt. I'm so proud.
I know. This is the way to go.
I was in the car on the way to work this morning reading this story from Politico, and I just smiled from ear to ear. It was just like,
thank you.
God bless the Italians.
For trying to bring some health and sanity to the diets.
You know, just to try and
people
bring
worldwide.
real food to the people of Germany.
Preach.
Up next on this programme, a big rebuild in Baltimore.
The path to normalcy will not be easy. It will not be quick. It will not be inexpensive. But we will rebuild together.
A conversation up next. On the ground, Kelly Lyons, just around the corner. Drew Mattis met life just writing in. Great story. Says one time he was delayed, 10-hour delay in Rome. And all the Americans immediately went to the counter and were asking for any flight to the East Coast. And all the Italian passengers were asking who was going to feed them.
That's amazing.
Said my wife and I still laugh about it. Isn't that a great story?
Well, who and what are they going to be fed with?
It's just fantastic. Love that. If you're just joining us, welcome to the programme. Equity futures on the S&P 500 shaping up as follows. The S&P positive by 0.4%. Yields just about unchanged on a 10-year, 422.58. Under surveillance this morning, a big rebuild in Baltimore.
Our work is just beginning to rebuild this bridge and deal with impacts in the meantime, to reopen this port and deal with supply chain impacts. The path to normalcy will not be easy. It will not be quick. It will not be inexpensive. But we will rebuild together.
Here's the latest we have this morning. Officials suspending search and rescue efforts with 6 individuals unaccounted for after the collapse of the Francis Scott Key Bridge in Baltimore. President Biden pledging federal support to rebuild the bridge with weeks or possibly even months of disruptions expected. On the ground is Bloomberg's Kelly Lyons. Kelly, we've been talking about this through this morning, how bad it was, but how much worse it could have been.
Absolutely, John. Of course, there was this construction crew present on the bridge at the time that the dolly rammed into a structural support beam and it subsequently collapsed. It is those 6 individuals that they are now not searching for rescue purposes, but for recovery purposes. But the fact remains that there was enough time from the Mayday call of the ship in which they, of course, were experiencing distress, ultimately lost power and control of the vessel, hence the collision with the bridge. They were able to alert port authorities soon enough that they stopped further traffic from coming onto the bridge. So it is likely that that action was able to save some lives here, even though, unfortunately, it does seem, according to officials, that 6 other lives are presumed to have been lost at this point. That recovery effort is ongoing as we speak, and then it will move forward into the investigative phase. The NTSB likely to board the vessel today to begin their investigation with a 24-person team. And then, of course, it's going to be a matter of trying to actually get the ship out of the harbor and clear the debris, not just from the ship and its containers, but from the collapsed bridge as well. This is going to be a multi-pronged effort. And I actually spoke yesterday with a Democratic senator of Maryland, Ben Cardin, about those future steps. This is what he told me.
Search and rescue is the priority, but they're already planning on what's going to be necessary to get the channel open and to get this bridge replaced. Every day it's closed. Every day the harbor's closed. It's millions and millions of dollars lost to the local economy. People are going to be out of work. They're not going to get paychecks. We got to move with great dispatch.
So clearly there is an economic impact here locally for Baltimore. There are more than 100,000 individuals whose jobs depend on the operation of the port of Baltimore. But there's also the consideration of the ripple effects it could have for the national economy. And the fact remains there is just no timetable at this point firmly that authorities have been able to point to estimate, to indicate when the port may be back open or when this reconstruction may happen and how long it may take.
Great interview with Senator Cardin. He also told you he's hopeful that Congress will actually act and step up when it comes to the funding to rebuild this bridge and the funding to support the port. Keely, how quickly could we see Congress act?
Well, that's an excellent question, Annmarie. Of course, we heard from President Biden in remarks yesterday. He said he does intend for the federal government to pay entirely for the reconstruction of this bridge. In theory, some of the funding breakdown will happen more immediately from emergency funding. There's a question of what infrastructure funds that have already passed Congress could be drawn upon for this effort, but likely it will require a supplemental request from the White House to Congress. And yes, Senator Cardin, as well as his other Democratic senator from Maryland, his colleague, Chris Van Hollen, both expressed confidence confidence that Congress will do what it takes to get this passed and that the Maryland delegation will be pushing for it. We have seen that funding is very difficult to get across the finish line in terms of the actual appropriations, the fiscal year that it took almost 6 months to actually finish and get through both the House and the Senate. And of course, a supplemental funding request related to emergency aid for U.S. allies still has gone nowhere in the House. So we'll see if this can happen in a more expeditious manner. It is worth keeping in mind that Congress is in recess this week. As we speak, they won't be returning until later on in April.
The International Longshoremen's Association 6-year contract, Kayleigh, is also coming due this year. How does this impact those negotiations?
It's a good question. Obviously, we have seen some disruptions of port workers broadly, not just here on the East Coast, but the West Coast as well. It took some time to get that dock workers contract sorted. And as I said earlier, there are thousands of individuals who are employed by this port who are probably worried at this time about job security. This is something that I actually had indications of in my conversation with Senator Chris Van Hollen. He talked about how, yes, we are seeing companies already diverting cargo, some of these shipments moving to ports either to the north, like New York or New Jersey, or to the south to Norfolk down in Virginia. But he wants to make sure that things come back to Baltimore when this port is reopened, that this is not a permanent disruption to trade flows, but just really a temporary diversion until the port can be reopened, that there will be job security for all of those here in Baltimore and the wider economy that depends on the operations of this port. And that is likely something that they will be looking for in the months to come.
Kayleigh, can we just finish up with a description of what you actually see with your own eyes? Because, Kayleigh, I think it's amazing to be sitting here talking about the rebuild. We need to talk about the cleanup. There is a 1,000-foot ship stuck there and the bridge debris all over the place. How long is that going to take?
It could take some time, John. Really, frankly, the scene we see before us is almost apocalyptic as you're coming in off the highway, of course, that you can transit to come here to the actual port area. You see a bridge that once was very prominent in the Baltimore skyline that is just no longer existent. Parts of it still sticking up, many parts of it submerged. Right behind me is a highway that literally goes to nowhere. It just cuts off because there is no continuation over the water of a structure that can support vehicles to go across. This is really extensive damage that has been done, of course, because this is, as you say, a very large vessel that ran directly into a beam of support for this bridge. It only took seconds for all of it to come crashing down, and it's likely going to be a long effort, not just to get the debris off of the ship, to figure out what is happening with the actual shipping containers that were on it, whether any hazardous contents were inside. Once you get the ship out, then you got to start getting everything out from under the water.
Hey, Kayleigh, wonderful to hear from you. Kayleigh Lines there in Baltimore. Lisa, just going through why this cleanup could take a long, long time.
Which is the reason why there's some estimates that that ship isn't going anywhere for weeks, if not even potentially months.
Yeah, never mind the rebuild. Got to get through the cleanup effort first. Coming up on this programme, Jeremy Papin, the chairperson of Nissan Americas, on how they plan to compete in the EV market. That conversation up next. Stock market bouncing back by 0.4% on the S&P 500. Pretty stable gains through this morning so far. On the Nasdaq up by almost 0.5%. Outperformance on the Russell, the small caps up by 0.7. In the bond market, 2-year, 10-year, 30-year. Look a little something like this, 458.48. Yields a little bit lower by not even a basis point on a 2-year. Similar price action on a 10-year at 422.18. I'm actually pretty interested in what Mr. Balls over at PIMCO had to say in the FT yesterday. If you want duration risk, why take it in the United States, given the limits that people perceive there are to the rate cutting cycle, and ultimately the growth story in the US is much better. If you want to take duration risk on a growth slowdown on a big rate cutting cycle, should you take it elsewhere?
That, to me, honestly, also raises questions about, is the U.S. in a uniquely inflationary moment that's different than, say, what you're seeing in Europe, just simply because it is a beacon of strength. And yes, maybe there are productivity gains, but there also are limits to that. And we're seeing that in the goods sector with maybe the end of some of the disinflation there.
Speaking of unique moments, switch at the board and get to foreign exchange. Dollar yen. Overnight, session high, 151.97, triggering some verbal intervention, strongest yet. without any currency intervention off the back of it. 151.06 is where we are now, down a third of 1%. That is Japanese yen strength. The BOJ, the finance ministry, the Financial Services Authority over there getting uncomfortable with the one-way traffic we've seen in the currency market.
How uncomfortable are they? And basically, that's the question that the market is asking, because it doesn't seem like there's particular concern that there's going to be some dramatic intervention that's going to reverse the slide in the yen. At this point, you have to get the finance ministry and the Bank of Japan on the same page, or else, frankly, this market is voting with the Bank of Japan, and the Bank of Japan is in no hurry to really raise rates materially.
Yeah, that dovish hike, a regret, do you think? Maybe?
It doesn't sound like it, because we heard from a Bank of Japan official overnight, and this is what triggered the additional weakness, basically saying we need to be cautious, we need to be very, deliberate and slow, basically doubling down on the moves that they just took.
151 on dollar yen. Under surveillance this morning, 6 people presumed dead after the collapse of the Francis Scott Key Bridge in Baltimore. President Biden saying he wants the federal government to pay for the rebuild, vowing to, quote, move heaven and earth to reopen the port and rebuild the bridge. The collapse posing a further strain to global supply chains, with the port one of the busiest on America's East Coast. Annmarie, the rebuild, you've got to do the clean-up first, which is what we talked about with Kayleigh just moments ago.
Absolutely. What you're hearing from officials is that this is going to take weeks, if not months, just for the cleanup before we even start talking about the funding and what's going to be needed in terms of the infrastructure to rebuild this. I will go back to what Brendan Murray said earlier, though. Is this an isolated choke point, or can we potentially see a domino effect? It looks like at the moment, companies are already able to reroute. GM, Ford, they're saying we're going to move to Georgia. You brought up a great point about coal to India. That's a lot of coal that actually goes to India from this port. Are they going to have to rely more on Russia and potentially Australia to bring in some of those coal? And then at a time, we are seeing commodity prices on the upswing.
What I want to understand also from executives in some of the industries that use this is just how much are they building in things that previously were thought as inefficiencies to compensate for disruptions in supply chains? How much do you have to do overlap just to keep that security in place post-pandemic? And that is something a lot of people have been really looking at.
Well, this could be a big disruption. Here's our next story. This from China. It's filing a complaint to the World Trade Organization over America's EV subsidies, saying parts of President Biden's Inflation Reduction Act are, quote, discriminatory and have seriously distorted the global supply chain for electric vehicles. The US hitting back. Top trade official Catherine Tai saying China continues to use, quote, unfair policies and practices to undermine fair competition and dominate global markets. Now, often economics can come up with its own jokes, Bremo, but the complaint that we're getting from China is very similar to what we heard from some European officials on the same issue.
Okay, there is maybe some legitimacy in terms of what measures are being taken. At the same time, it is a bit rich for it to be coming from China. And basically, the tit for tat, we have Janet Yellen, Treasury Secretary, speaking in Georgia this morning, talking about China's overcapacity distorting global prices and talking about how this is a real competitive disadvantage. This is going to be the tit for tat. But now how much is this protectionism and nationalism and all that, and this sort of the new reality for the global economy?
I had the same thought you did, Jonathan. When I saw this, I said, well, there's some Europeans who actually would agree with Xi Jinping when it comes to this. But I think the nail in the coffin for China was in the recent months, the United States finalizing those reductions. And if you're from a country of foreign entities of concern, a.k.a. China, you can't tap into those subsidies, which means no one's going to buy your cars in the United States.
Stones, glass houses, all round on this front, right? I think we can all agree on that. Sticking with EVs, shares of BYD falling in Hong Kong trading after the Chinese EV maker's earnings missed estimates, raising questions over whether it can sustain its strong profit growth amid an intense price war. One company looking to double down on EVs is Nissan, the Japanese automaker targeting an additional 1 million vehicles by 2027, including reducing the cost of EVs by 30%. The CEO saying, quote, we have to change our ways to compete with companies like BYD. Joining us now is the chairperson of Nissan Americas, Jeremy Papin. Jeremy, great to catch up with you, sir. Let's just talk about the new release for you. And you help me understand what's going on in this market at the moment. Nissan Kicks. I know you're excited about it. I want to understand if there are too many EVs in this market or whether you just think there's not enough at the right price point.
Yeah, look, we're very excited about the Nissan Kicks. It's, I think, the car the customer wants at the moment in the US. It's a combustion engine, absolutely great design, affordable price point. We're bringing a lot of technology, a lot of fun to drive to the marketplace. And so we think we're just hitting the market with a new vehicle in the sweet spot of what the consumer is wanting at the moment. That's for the new Kicks. In terms of the EVs, the growth is there in the market. perhaps the consumer moving into the EVs is at a slower pace than what some had dreamed about. But the growth is there, the interest is there, consideration is growing, and once people have driven EVs, they are very loyal to that type of powertrain, and so we think we will be seeing a steady growth in the market.
Jeremy, there are some reports that you have to offer dealers at the moment anywhere between $500 to $2,000 cash per vehicle to take on more inventory. I'm just trying to get some transparency from you just to how difficult things are in this moment. Jeremy, is that story true? Can you verify that?
I think the story is a market story. I think there are a number of brands that have to deal with some inventory situations, and helping the dealers with floor plan and availability is part of our job. We're doing it in cooperation with the dealers, and so it's just short-term epiphenomenon. I think the key is having exciting brand advertisement and bringing the new cars to the market for the consumer to show up on the showrooms and take those cars home. So there's nothing specific to what Nissan is doing in the market at the moment. We are adjusting to good demand and the fact the consumer is looking at this monthly payment, and we're helping them in every way we can.
Are dealers pushing back, Jeremy, more on having more electric vehicles on their lots simply because there hasn't been the demand that many people were expecting?
I think the dealers, they do see the growing interest. They do also face the need to perhaps spend more time through the process of explaining all the technology that goes into the EVs. I think there's one point of notice that Nissan is offering is that we know there's a lot of technology that goes in the EVs. We are offering a second delivery, which is an opportunity for the customers 8 days, 15 days after buying an EV at Nissan to actually have someone come home and re-explain and reintroduce and make sure all the technology is being used the right way, whether it's EV charging, ProPilot Assist, driving assistance, or any of the connected services features that we have to offer. And I think that's what we all need to do is educating and supporting the customer into getting the full access to what we have to offer through EVs, because they are packed technology cars.
But how do you keep up when BYD continues to cut prices?
That's a story of the industry. There's been always the need to be cost efficient. And so I would say we're very used to it. Ourselves, we're working on breakthroughs for our EV production, fewer parts, more simple to produce, greater economies of scale. I would say it's just what the auto industry is about. There's nothing specific. One day, one company is more aggressive on prices. The next day, it will be maybe another one. And we keep up with the pace of transforming those productivity gains into more affordable products for the customer. So it's healthy competition.
Do you think the market missed an opportunity to push hybrids, given the fact that we've seen more uptick in hybrids and people have been a little bit resistant to go full EV?
I think what matters is the fact that we can all offer what the consumer wants. In our plan that you've mentioned, the new ARC plan, the midterm plan, we will be launching 30 new cars and trying to grow the business by 1 million units. 15 of those new 30 cars will be electrified. And in the US, we will get 7 new cars over the next 3 years in all powertrains, combustion engines, battery EVs, hybrids, PHEVs, because what matters is just to be able to offer the consumer what he wants. And so that's coming, that choice, I would say, is coming in greater numbers, including at Nissan.
Jeremy, I feel like we should call all executives of car companies ambassadors at this point, because it seems like you're trying to navigate the geopolitics of the world in a very fraught moment. And I wonder how much you're having to change your business structure to prepare for increasing tensions in different regions where you're not allowed to sell vehicles with parts from other countries that are specific.
I think the industry praises stability of rules and can cope with any rule that is being set. And so that's the most important for us. We make decisions early on. We make decisions today on the products that will hit the market in 2028, 2029. Billions of dollars are being invested. And so what matters is the stability of those rules, essentially whatever they are. And so that's what we're very focused on. We know how to adjust to any set of regulation that is being thrown or set up for us. And that's how that's where we make our business.
Jeremy, what I struggle with now is how you gain economies of scale, trying to do three different things simultaneously. So to satisfy the Chinese market with EVs and to simultaneously satisfy the US market with hybrids, you've got to do different things in different places. How do you generate cost reductions, achieve economies of scale when you have to do all of those different things simultaneously?
Yeah, I think regional size is what matters. China for China at Nissan is something that's working very well. And we will be launching in China over the next few years 4 new energy vehicles completely developed, localized and produced obviously by our Chinese for China business. And then elsewhere in the US, in Europe, or in our Japan business, we're trying to leverage global scale where it works or regional scale where it can. We've got a very big presence in North America, both in US, Canada, and in Mexico. And there's enough volume to generate, again, the economies of scale to be competitive. And being competitive just means bringing the cars at the right price for the customers to be very happy with those.
The question that Lisa asked, though, I think is a really important one, and it plays into this discussion that we are having. Can you generate global scale when it feels like these markets are becoming increasingly regional? And you mentioned the regional effort. I want to understand, and I'll ask you direct, what happens if we get the former president coming into power and he doesn't just put big tariffs on what's happening in BYD and with Chinese automakers in Mexico? He does it across the board, puts the walls up and shuts everything down. If we shut down the global auto market, it becomes heavily regionalized. Does it change what you do, or do you think the market was already moving in this direction?
I think the market is moving. I mean, with COVID and the semiconductor crisis, we've been obviously much more knowledgeable and careful as to how the logistics routes are set up across the industry. We've been thinking about dual sourcing and more insuring of the activities. And so that's a trend that, we want to continue. Building where you sell is a recipe for success in this industry. And so we are obviously very committed to making investments in North America that will help manufacture all the vehicles that will be sold here. And that's really, and so again, any change in regulation, I would say, we can cope with and adjust gradually. They just need to be stable over time.
Jeremy, thank you, sir. Nothing stable about the last few years. Jeremy Papin of Nissan Americas, thank you very much and good luck with the new product launch. We'll speak to VW a little bit later. And I think the conversation we have to have with VW is how do you plan for your manufacturing footprint in the United States of America before getting clarity on the future? Clearly, they'd like stability. Stability is not what we have in Washington, D.C. at the moment.
Also, the point about if Trump were to come into power, those subsidies that are driving some of the EVs, even though this market is seeing a glut and we're not seeing that demand, the subsidies are there to try to help. If Trump comes in, maybe they won't attack the full IRA, but he can rewrite the Treasury rules and make it much harder at the Treasury Department, make it much harder to claim those subsidies. So until you know who's going to be president, it's also very hard to see the demand and what's it going to be for the EV market in the United States.
Some pretty lofty goals over at Nissan. We'll catch up with VW in about 60 minutes from now. If you are just joining us, equity futures on the S&P 500 trying to bounce back near session highs. Lisa, still positive about 0.4%.
Right. It's basically stability there. Elsewhere, maybe not so much. Let's get you an update on stories elsewhere this morning. The search and rescue operation after the collapse of the Francis Scott Key Bridge in Baltimore is now a search and recovery mission. A road crew was working on the bridge at the time of the collapse. 2 people were rescued. 6 remain unaccounted for. The area remains closed off to traffic, cutting off a major artery around the city. UBS has finalized a deal with Apollo Global Management for the carve-out of Credit Suisse's Securities Products Group. Apollo said to purchase $8 billion in senior secured funding facilities. The deal allowing UBS to close another chapter in its acquisition of Credit Suisse. It'll book a net gain of about $300 million in the first quarter on the sale. And Brent could hit $100 this year if Russia's decision to cut production isn't balanced out by other countermeasures. This according to analysts over at JP Morgan. The bank saying the actions could see the price of oil hitting $90 next month, close at triple digits by September. Russia saying its decision to deepen its production cuts was based on expectations for global oil demand growth. So this really raises this question. Is this the boy who cries wolf again? Because we've heard this before. Or is this truly going to be the time where the market wakes up to the fact that demand isn't falling off a cliff?
Yep.
And we are seeing supply that is being constrained.
We reflected on the Morgan Stanley forecast, which was something like $90 Brent 3Q. And 90 sounds like a big number. Then you look at Brent, which is basically 86. We're $4 away. We've had this sort of stealthy rally back higher in crude.
Which raises a lot of questions about the timing, because not only are we talking about the disinflation narrative and whether this challenges it, but we're also talking about, you know, the silly season for politics, as TK would say.
That's the latest in the commodity market. Up next on this program, the competition for capital.
You really have started to see the competition between public markets and private markets drive credit spreads tighter. Over time, you're going to see a convergence of those two markets, and it does create a bit of froth with pushing spreads tighter.
That conversation up next. We'll be catching up with BlackRock's Amanda Liner. Following 3 days of losses on the S&P 500, equities bouncing back on the S&P, up by about 0.4% through most of this morning so far. Yields just about unchanged to down a basis point on a 10-year, 422.18. Under surveillance this morning, the competition for capital.
I think the story has changed where there's such a competition for capital that you really have started to see the competition between public markets and private markets drive credit spreads tighter, start to make covenants a little bit less strong. Now you're seeing it look much more similar to public markets where there's lending groups, including private and public lenders. And I think over time, you're going to see a convergence of those two markets, and it does create a bit of froth with pushing spreads tighter.
Here's the latest. Credit spreads at their tightest levels going back to 2021, with investors weighing how Fed rate cuts could see them tighten further. Amanda Liner of BlackRock expecting cuts to start in the second half and writing this. While a high for longer cost of capital environment poses fundamental pressure for some floating rate borrowers with limited financial flexibility, competition between syndicated and private markets coupled with ample private debt dry powder has encouraged tighter pricing, especially for large borrowers who have access to both markets. Amanda, I'm pleased to say, joins us now for more. Amanda, good morning to you.
Good morning. Thank you.
The E&P Paribas were with us yesterday, and they were talking about a soft landing in credit. Is that your kind of world, your view on things at the moment?
And good morning. Thank you for having me. I did see that interview with Megan yesterday. I think I would agree with that. I think the bar for significant disruption is really high in the corporate credit market. We do, though, expect dispersion. And we are actually seeing that to a pretty significant extent more recently in the U.S., European, and Asian credit markets. Two things I would note. On the point of kind of competition between public and private, I think the way we're viewing it as maybe several years ago, if you were a corporate in LevFin, you would have made the decision between issuing a bond and issuing a leveraged loan. Now there's a third option. And so you've actually seen private credit become a viable option for the opportunity set for a lot of corporates. Not every corporate needs the size to become index eligible in that market, but it is a viable third option. The other point is, I think, on just the terms of having more access outside of the banking channel and the public markets, we believe has been a good thing for corporates. And you actually see that in what I would argue is a pretty muted default rate, given the interest hikes that we've had since March of 2022. And I think that shows that it's working.
And Bob Michael of JP Morgan was talking about that, the ballast kind of to some of the credit sphere. I do, though, want to just sit on this idea of froth. Yes. And that's something that Megan was talking about, that there is this froth developing in tighter credit spreads because of the increased competition. Sounds a lot like the equity market. Exuberance, but it makes sense. So it can go on for a long period of time. Is that kind of what you see?
We see it, and I would say it's not exclusively limited to the LevFin market where there's overlap with private credit. You also see super tight credit spreads in investment grade. To me, actually, it reflects a few things. One is fundamentals are pretty good. Economic backdrop is pretty strong. But if you look at spreads, they look really tight optically. If you look at all-in yields, however, going back to the post-financial crisis period, we're talking really cheap levels on a percentile basis. If you were to look at just daily spreads, daily yields back to 2010, yields screen really cheap and spreads screen really rich. So I think that's part of it, is that the marginal buyer in credit is actually yield-based. So when they're coming to deploy capital, they're not looking at it on a spread versus an index. They're looking at where can I lock in all-in yields. And I think it's fueling some of that optically tight spread measures in credit, as opposed to it's not indiscriminate, because, again, we are actually seeing triple C's lag. We're seeing actually a pretty significant share of credits that are trading above 1,000 basis points in spread. You're seeing dispersion in the single name capital structure, over leveraged capital structures that are doing liability management. So I would say if it were kind of a rising tide lifts all boats and everything was rallying, I would say we are entering into kind of maybe possible over exuberance. But we're not seeing that. We are actually seeing some discrimination under the surface.
That's what I really wanted to get into. If I just go over a part of that quote again and just read it out loud for the audience. Competition between syndicated and private markets coupled with ample private debt dry powder has encouraged tighter pricing, especially for larger borrowers.
Yes.
Is it just the larger borrowers? Who's getting left for dead here?
I think it's largely in the high end of the size spectrum, where companies have the ability to run dual track processes, so they can actually see, okay, again, going back to that point of I've now got this other third viable option, where am I getting best execution? I think the pricing is most competitive at that end. But again, it's not. I do think there's not a sense that folks are being left behind, in the sense that that competition is pricing them out. I think what it is doing is it's just changing that mix shift. In late 2023, we saw a lot of public debt being refinanced with private debt. That shifted in the first quarter, now that the syndicated markets are open, and we're seeing a lot of private debt actually getting refinanced in the public markets. But those companies need to be ready to be public market.
Just following up on Megan's point, how concerned are you about weakening covenants, weakening deal terms? Is this something that you see sowing the seeds for something that might not come home to roost this year, maybe not in 25, but maybe 26?
Yeah. Well, most of the syndicated market is cov-light, as you know, on the leveraged loan side. And as the high-yield bond market has become more institutionalized, covenants have become less of a binding constraint in that market, too. It's really the private market that has a lot of the covenant protections. I think the big risk that I'm concerned about for risk asset valuations is a sustained reacceleration in inflation that the Fed cannot deliver at some point in 2024 on rate cuts. Not that rate cut in the form of rate relief is so game-changing for those credits, but I do think that it's really important for sentiment. And I think that's where you might start to see things really unravel from a risk asset side, is that we don't get any rate cuts in 2024. We're in this extended high for longer into 2025. And I think the key there is, if that's happening because inflation is sticky, that is problematic. If rate cuts are very shallow in 2024 because of high growth, I would view that as less of a problem. But if that gets postponed, I think that's an issue.
Just quickly, maturity wall.
Yes.
Red herring or not? Big issue or something to ignore?
I was very concerned about it in the fall of 2023. I think the fact that the capital markets have remained open to lower-rated issuers to allow them to get that refinancing done, it's relieved a lot of pressure. In European high yield, it's a steeper maturity wall than the U.S., so I'm watching there.
Interesting. Thanks for that. Amanda, great to catch up. Thank you. Amanda Lanham there of BlackRock. Had to get something bearish in for Bramo at the very end of the conversation.
But basically,
anytime.
she didn't really bite. She said, ignore it.
Watching Europe, though.
Yeah.
Interesting.
Thank you. Thank you
there
for throwing that to me.
Anytime, that's what I'm here
Europe
for.
is the bearish place.
Coming up, Keith Lerner of Truist. What's new about that?
Fair.
Yeah, I know. Rich Clara of PIMCO and Pablo de Cid of Volkswagen. All of that and a whole lot more from New York City. This is Bloomberg.
Central bank policy, particularly with regard to the Fed, is very, very binary. They either cut or not.
They don't need to wait for inflation to come all the way back down to 2% to actually start cutting rates. We just need to be confident that things are evolving in the right direction.
They're kind of trying to tell us that we're on a path to get to rate cuts now. Inflation has come down enough that they think that they can be cutting interest rates.
We can still get 3 rate cuts despite some of the hotter inflation data.
They're trying to play the waiting game. Eventually, they're going to have to suppress the front end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Equities trying to bounce by, let's call it 0.4% on the S&P 500. Pretty stable gains through today. Nothing stable about the last 24 hours. A tragic bridge collapse in Baltimore. And a big question being asked in the world of economics. Just how fragile global supply chains and how fragile is that goods disinflation we've seen over the last 6 months. Going into PCE, Lisa, Friday morning.
We thought that supply chain shocks not were behind us, but at least had subsided. And this raises questions of how vulnerable the global economy is to one artery that's not even that significant on a global scale being disrupted. A lot of people gaming out that it wouldn't necessarily be massive. Nonetheless, a disproportionate effect on specific industries. You pointing to coal.
Yeah, coal in a big way. The word I've heard a lot in the last 24 hours is just time. This is going to take time to figure out the disruptions. It will take time to clean up. And Annmarie, it will take time to rebuild, and a heck of a lot of money as well.
Absolutely. And when it comes to time, Bloomberg Economics is talking about if this isn't quick, potentially it will have that inflationary impact on the end of the year inflation numbers. Time to rebuild means it's going to take also a ton of money. We're going to get an update actually this hour from Governor Westmore of Maryland, potentially before Jonathan, your point earlier, before we start talking about the rebuild, he's going to really lay into what's happening in terms of the cleaning up of what is going on, getting that ship actually out of the way and opening up that channel.
On the economics question, decent conversation with Andrew Honhorst of Citi just yesterday. I want to go through the quote that you shared in the newsletter just yesterday morning, Lisa, that the period of deflation in goods that we've been in for the last 6 months or so, we're probably coming out of that now. And how much of a challenge will that be? Particularly, we need the services now to do some of the heavy lifting, a lot more of the heavy lifting. Andrew's point is that for services to do that, it's going to require an economic downturn, which is not the central case, the base case on the FOMC at the moment.
It's kind of what Bruce Kasman was referring to as well when he talked about how services side inflation has remained stickier, and he expects it to continue so. So in other words, a lot of the disinflation that we've seen has come from the goods sector. And we've heard time and again before this additional disruption that might not be that significant on the overall numbers, significant for the region and for the lives. But what we're looking at right now is a situation where commodities are coming back up, goods prices are coming back up. It's a new era where a lot of people are going to see some real challenges fighting inflation.
Crude front and centre to that, without a doubt. Friday morning, PCE data, that's just around the corner, a few days away. Then you'll hear from Chairman Powell a few hours after that as well. Setting up the market, the price action this morning. Equities are doing all right, up 1/3% on the S&P. In the bond market, things shaping up as follows. Yields down by, let's call it a single basis point, 421.79. Lisa, you're calling it boring. Some people might say maybe it's just stable. Things have calmed down just a touch.
Well, this is where I would push back. If it was just stable, why the dramatic sell-off in things like NVIDIA last night in the last half hour of trading? It doesn't feel like there is necessarily a ballast of calm as much as a lack of conviction. It is a different kind of moment that's fraught, I think, for the potential for some news to really disrupt things.
We'll ask that question to Keith Lerner of Truist. He joins us in just a moment, weighing in on the market resilience. We'll catch up with the former Fed Vice Chair, Richard Clarida, on the central bank's path forward, and VW North America CEO on the company's EV strategy. That conversation about 40 minutes away. We'll begin with our top story in markets. Stocks mixed as investors await the Fed's preferred inflation gauge coming Friday. Keith Lerner of Truist saying this: the equity market has been fiercely resilient since the rebound off the lows last October. Strong price momentum, like we have seen over the past 5 months, tends to occur in the midst of bull markets and is a sign of underlying strength. We still expect to see normal pullbacks along the way. However, we suggest investors stay with the primary market trend, which is up, and look to pullbacks as opportunities. Keith joins us now for more. Keith, 5 months of gains, that's what we're on track for. It's almost been uninterrupted. I think in that period, just 3 weeks of losses, and 2 of them came in the last month or so. Keith, why do you believe this can continue?
Well, first, great to be with you. And as you've said, I mean, it's been an extraordinary 5 months. I would say, just looking back as a starting point, when we've seen 5 months of gains of more than 20%, where the cumulative gain has been more than 20%, we've only seen this happen about 10 times since 1950. And a year later, you've been up every time with average gains of double digits. Now, to be fair, that's only 10 times, so that's just a starting point. The market on a shorter-term basis is somewhat stretched. Sentiment's a little bit stretched. But in general, when you see strong momentum, like we saw late last year, like we saw breaking out of that 2-year range in January, and now this, those are things that tend to happen in a bull market, and the surprises tend to be to the upside. So again, I want to be also balanced insofar that, historically, you've only had 3 years since 1980 where you haven't seen at least a 5% pullback. But if you're in a bull market, you stick with the primary trend and you look at those pullbacks as opportunities.
Keith, this hasn't just been contained to the United States. We've seen it in Europe. We've seen it in Japan. Are you more confident in the story at home or abroad?
Well, I think, first of all, the market is still very, very strong. It's been a extraordinary 5 months. I would say, just looking back as a starting point, when we've seen 5 months of gains of more than 20%, we've only seen this happen about 10 times since 1950. And a year later, you've been up every time with average gains of double digits. Now, to be fair, that's only 10 times, so that's just a starting point. The market on a shorter-term basis is somewhat stretched. Sentiment's a little bit stretched. But in general, when you see strong momentum, like we saw late last year, like we saw breaking out of that 2-year range in January, and now this, those are things that tend to happen in a bull market, and the surprises tend to be to the upside. So again, I want to be also balanced insofar that, historically, you've only had 3 years since 1980 where you haven't seen at least a 5% pullback. But if you're in a bull market, you stick with the prim We are still Team USA, Jonathan. We've been Team USA for several years. I mean, as you pointed out, we're seeing better global breadth, meaning we're seeing, Germany, Spain, Italy, obviously Japan, which was, talked about a lot this morning, at multi-year highs. So I think we're seeing a broadening of the overall market, but we still like the U.S. for several reasons. One's the economic trends. That if you look at global economic revisions, the U.S. is still powering those upward revisions. Secondly, the earning trends are still much stronger in the U.S. relative to international markets as well. And the relative price momentum is also better. So for us to get more positive international, we want to see those earning trends start to flip. And normally those international markets do better when the dollar weakens and also coming out of a, major low or major, out of a recession. So again, we're watching. They're cheap. We think they've been cheap for a reason, but we're being patient before we shift that longstanding U.S. bias.
The U.S. bias being equity focused. I wonder if that really applies to bonds as well. We were talking earlier about Andrew Balls of PIMCO, quoted in a Financial Times article talking about how he likes longer duration bonds overseas, not in the U.S., because that strength is also coming with perhaps a stickier inflation going forward. Do you agree?
We're still more focused on the U.S. I think in some ways, as you invest overseas in the fixed income market, there's also that currency component. And you get the big kicker both in the equity market and the fixed income market when the overseas currencies rally or the U.S. dollar weakens. Our view is more that the U.S. dollar is in a choppy range. We think the relative economic strength and maybe the Fed being somewhat slower will keep that U.S. dollar somewhat supported. So we would prefer to just stick with high quality U.S. bonds and the most liquid bonds still in the world. And we're still, even though they're staying, pretty much in a trading range, you're still having the highest carrier coupon in 10-year treasuries that we've seen in about 15 years or so. So we want to keep it simple and just stay with the U.S.
We were just speaking with Amanda Lynham, and she said that really one of the big risk cases to her is if inflation remains sticky for longer, if the Fed is unable to cut rates. And that really does create a real problem, real questioning in just how much the Fed has the back of markets. Is that something that would shake your view as well if the Fed was forced to keep rates here simply because inflation and strength has just been so consistent?
It's a delicate balance. I mean, our motto really for most of this year is that we would prefer less rate cuts and a stronger economy to a weaker economy that needs more rate cuts. I think the environment that would be most problematic would be more of stagflation. We're not seeing that as well. I think if the Fed, if the market shifted from basically where we've been all year long is 3 rate cuts to no rate cuts, I think that would be problematic from a valuation standpoint. There would be some offsets, right? Why are they not cutting inflation? But also that likely means that earnings are also moving higher as well. So it's not just straightforward that the Fed doesn't cut rates and the market sells off, because earnings should stay strong in a nominal environment where economic growth and inflation stays somewhat higher. But I certainly think it caps the upside and likely probably leads to that, a gut check at some point in this market.
Keith, I've got no idea what happens in the future, but I do want to understand the past just a little bit if we can. Keith, we have priced out a load of cuts over the last 3 months or so, and valuations haven't come down. And I'm just wondering what the relationship actually is.
Well, there was an extremely close relationship for a while, whereas the Fed or the expectations for the Fed to cut rates came down, the market was moving up. That became unhinged earlier this year. And I think the reason why that is because if you look at GDP estimates on Bloomberg, right, you can see that the revision trends for GDP estimates for the U.S. continue to move up. And you also see forward earning estimates for the S&P make a record high week after week after week. So I think the market can still do fine as long as those earning estimates and GDP revisions stay strong. That will offset the need for those cuts. I think the market's also getting more used to these higher rates. And also, if we look back historically, we did a study, I think late last year, the average cash rate for the last 40 or 50 years has been about 5%. The average 10 years has been around 5%. And the equity market has done just fine in that environment, up double digits in general. So it's almost like we have this recency bias after the global financial crisis, when in some ways we've moved back to somewhat of a normal environment on the interest rate front. And stocks can do well in a nominal environment where inflation is a little bit higher and interest rates are back to more of a normal state.
Keith, do you believe this is sort of the old normal, a return to that?
It's a new normal, right? I mean, it's not the state we've been in since the global financial crisis. We're not going back to the 70s. So we're creating our new normal. But I think in some ways, what was really more abnormal was really that last decade. And maybe it's somewhere in between those two different phases. But I do think that economic growth is probably going to be a little bit higher than following that post-financial crisis. I think inflation just stays somewhat higher as well. And I also think valuations for the market, they're elevated by any metric. That's a risk, but it's not an apples-to-apples comparison either there. In 1990, the technology sector was about 5 or 6% of the S&P. Today, it's 30%. So, and those sectors tend to have higher multiples as well. So again, history is, it's not always an apples-to-apples comparison.
Before we let you go, Keith, I want to just circle back to something that we've been talking about a lot over the past couple of weeks and that came into real clear focus yesterday. Even though we seem addicted to our phones, we're very much living in a physical world and the nuts and bolts that haven't necessarily seen the same kind of investment. How much are you sort of trying to ride the industrialization wave or the reindustrialization that we keep hearing about that's been part of some of the commodity story that we see playing out?
No, it's a good point. I mean, we've been overweight tech and communications and financials. Our work is starting to be somewhat more favorable towards some of these deeper cyclicals. And I think if you think about like the industrial sector, it's at an all-time high. It made that all-time high right alongside technology early on. If we look at a lot of these infrastructure bills, a lot of that money is hitting now as well. So I think if you think about the next 5, 10, even longer than that, I think this industrialization, this onshoring, has long legs to go, and I think that will be an attractive area of the market for some time.
Hey, Keith, good to get your thoughts. An update from Truist. Keith Lehner there of Truist. Thank you, sir. Appreciate it. On the growth policy mix, the optimal mix at the moment, and why this equity market rally can continue, perhaps through to the end of this year. Equities right now still rallying. Lisa positive by 0.38%.
Yeah, although coming off just a couple basis points. Let's get you an update on stories elsewhere this morning. The search and rescue operation after the collapse of the Francis Scott Key Bridge in Baltimore is now a search and recovery mission. A road crew was working on the bridge at the time of the collapse. 2 people were rescued, but 6 remain unaccounted for. The area remains closed off to traffic, cutting off a major artery around the city. Chinese President Xi Jinping has told a group of American business leaders in Beijing he wants U.S. companies to invest in China, putting aside differences on, quote, minor issues. Xi met with leaders including Blackstone's Steven Schwartzman and Qualcomm's Cristiano Amon for more than 90 minutes. China is seeking to restore confidence in its economy, with Xi acknowledging issues with the domestic economy, but saying it hasn't yet peaked. Trading platform Robinhood is rolling out a credit card as it looks to further push into the consumer market. The Robinhood Gold Card will be offered exclusively to members of the company's subscription-based Gold Investment Suite. Members won't have to pay annual or foreign transaction fees and will receive 3% cash back on all purchases. That's your Bloomberg Brief. John.
The goal is for all our customers to hold all of their assets in Robinhood and for all of their transactions to go through it. It's a pretty good goal, isn't it?
Okay, just taking a step back.
I'm not going to say whether that's achievable or not.
Well, I just want to say everyone wants to be a credit card company, whether it's the airlines or whether it's Robinhood. That's number one, even at the time of some potential pushback in the antitrust market. But number 2, how much is this gold card going to help to fuel the 0 days to expiration options market that people say is fueling a lot of the volatility in markets? I mean, this is a great story.
Are you saying this is an additional line of credit to buy stocks? Is that what you think this becomes?
I'm just saying, cash back, where does it go? It goes directly back into 0
the stock
days
market
to
and the
expiration.
vibrancy of American capitalism, which is exactly where that money should be recycled.
You think so? Rather than the physical world?
No idea. Up next on this program, Baltimore's bridge collapse, straining supply chains.
It's a large port with a lot of flow through it, so it's going to have an impact. We'll have to divert parts to other ports along the East Coast or elsewhere in the country, and it'll probably lengthen the supply chain a bit.
A conversation coming up next, live from New York City. This is Bloomberg. Live from New York City, about an hour and 13 minutes away from the cash open in New York. Equity futures positive by 1/3%. Bond yields a little bit lower, down a single basis point, 421.79. And in the commodity market, Joe Biden needs some good news fast. $81 on WTI, we're down 0.7% for the president. AAA warning, $4 crude at the pump. this summer. Under surveillance this morning, Baltimore's bridge collapse straining supply chains.
It's a large port with a lot of flow through it, so it's going to have an impact. It's just at this point, we'll have to understand what that means for us specifically. We'll work on the workarounds. We'll have to divert parts to other ports along the East Coast or elsewhere in the country, and it'll probably lengthen the supply chain a bit.
Here's the latest this morning. The Port of Baltimore now closed indefinitely, threatening to disrupt the transport of 2.5 million tons of coal and shipments of Ford and GM cars. The port is the second largest terminal for U.S. exports of coal and handles the nation's largest volume of automobiles. John Katsonis of Breakwave Advisors saying the situation will, quote, create disruptions in global trade, some that will be felt in the U.S. market, given the importance of the Baltimore port when it comes to importing cars and consumer goods. John, I'm pleased to say, is with us around the table. John, good morning to you.
Good morning.
I'm sure you've been super busy in the last 24 hours. Something we haven't done enough, nearly enough, I don't think, is really explore how big the ships are. And I know this is something you want to speak to. We're talking about something that is almost 1,000 feet long. And when you hear things like it's travelling by close to 10 miles an hour, it doesn't sound like that's that fast. You should be able to slow it down. Could you give us a better framework to think about the size of these ships and the kind of forces involved?
Absolutely. I mean, people have to think these are huge structures. Tens of thousands of tons that travel. The momentum for these structures to stop could take 10, 15 minutes for the moment you lose propulsion. So people, when they see the ship hitting the bridge, the engines have stopped way before, minutes before. It's not easy to really stop this at a moment's notice, like we're used to, with our car, for example. The other thing is obviously when this happened, a lot of the procedures were followed the right way. I mean, the ship through the anchor, for example, tried to slow down the momentum, right? They tried to route away from the pilot. But it is not something, I think it's more of the timing. The timing was really bad when this blackout happened. If it had happened like a few minutes later or before, this wouldn't have happened.
As an observer from the outside looking in, when you see the lights go off, come back on, go off, come back on, and black smoke starts to come out of the back, what was it that you thought was going on at that point?
Well, I think what people are doing in the bridge, trying to figure out what the situation is, right? They see suddenly things are not responding the way they should. Probably the emergency generators or the emergency system didn't work, or they weren't, they were malfunctioning. I mean, I'm pretty sure there was a lot of attending to solve the situation, and they did the right thing, right? They called the authority and they said, you have to stop the cars, right? So they did the things that they should have done. Probably, we don't know exactly what the situation was, but that's what I would imagine. But there's not really an easy solution. It's a timing more than actually what happened. I mean, a lot of ships get under these conditions, but you never hear about it because it's not in a bridge or in an area that affects anything. So it's not unheard of, but it's a timing.
When we talk about risk controls, some have postulated that maybe this is a result of dirty fuel. Does that ring true to you? Is there sort of a theory that you see as something that's more common for some of these malfunctions in the past that could be at the heart here?
So contaminated fuel could be the reason, and it's something that you hear in the shipping industry. I'm pretty sure that it's an easy way to find out. You can test the fuel. And I'm pretty sure that the investigators will find that. But yes, that could be one of the reasons.
One economic consequence people have been talking about is that even a 10% increase in capacity in flow to New Jersey, New York, Virginia ports will cause the same kind of backlogs that we saw during the pandemic. How concerned are you about that kind of additional traffic will cause ships to have to wait out in the harbor to get unloaded and to get sufficient dock workers to get it all done?
So the good thing is that we're in a slow shipping period, right? We're not in the Christmas period or pre-Christmas period. Right now is a slow shipping period, especially for consumer goods. So that's a positive. But you're absolutely right. I mean, the 10% sounds not a big number, but if the ports of New Jersey or down to Norfolk, Charleston, Savannah are already close to capacity, that can really create a situation there. And I think that's something that you cannot really gauge, you cannot really measure. Also, probably the West Coast can take some of the cargo and then rail it to the East Coast. That definitely increases prices. And that's part of, I think, the effects you might feel on the consumer side. But I don't think that is as, in terms of size, it's not going to be anything close to the pandemic, right? We're not talking about anything like that. But keep in mind, this comes on top of what's happening in the Suez Canal and the Panama Canal. So this is not like an isolated incident, because if it goes by itself, then it's not a big deal. But you have the Suez Canal, all the divergence around Africa, And then you have the Panama Canal, where you don't have enough water for the ships to transit, at least not to the rate that they used to.
This ship was built in Korea. We hear a ton of protectionist policies and rhetoric coming from Biden and Trump ahead of November. You don't hear it about shipbuilding. The U.S. doesn't make ships anymore.
Well, they do, but it's like 3 times more expensive. So it's not, I think it's a cost issue. It's not really, you don't do that. And you cannot compete in a protective economy in the shipping industry in the U.S. So that has been going for decades in the U.S. And everybody either complains or try to protect the industry, depending where you are. But I don't think that's an issue. I mean, Korea builds very high quality ships. This is a new ship, high quality built ship. It was maintained well. I mean, it's not really something that I think the focus should be in.
Given all your experience in this space, what do you think the timeline is for the cleanup and the rebuild?
So if you go back like 20, 30 years ago, a similar incident happened down in Florida. It took 7 years to rebuild the bridge. When you talk about that, I'm not a structural engineer, but that's something to think about. Reopening the port, my personal view is that it's going to take months. People talk about a few weeks, but if you see, everybody can see the structure and how much steel is in the water. Think about the salvage operations. How are you going to build this? How are you going to bring these barges and cranes to take all this steel out of the water? And then, of course, to salvage the actual ship, take the containers that were broken in the water, the cars. So I think it's going to be, longer than what most people think.
You've been an investor and analyst for more than 2 decades, I believe, 20 plus years. I'm trying to understand where the liability might sit. How are you thinking about that at the moment? The president's come out and talked about using federal funds to rebuild all of this. But as you think about who might be responsible for this, where would the liability sit and where would the insurance be?
Well, I mean, if you take the whole cost of this, is running to multiple billions. I don't think there's going to be anywhere close to that for whoever was responsible on the shipping side. Obviously, the P&I clubs will get involved. I think it's a much more complicated situation than just an accident, a shipping accident, because it's very rare that a shipping accident affects actually ordinary citizens or a structure that is standing there idle. So if 2 ships collide, then it's very simple. It's not simple, but it's easier to understand where the liability stands. Here you have like a sitting structure and a ship hitting this structure. So it's totally different. I think a lot of different parties get involved on the shipping side, but also on the actual, commercial side, call it.
John, this was thoughtful stuff. Love to do it again sometime soon.
Thank you for having me.
Because this is going to be an issue that lingers for a long, long time, Lisa, as the cleanup effort continues.
And as John was saying, it's not an isolated incident in the sense that we're seeing other shipping disruptions, which just raises this question. How is it going to be felt?
John Katsonis there of Breakwave Advisors. Coming up next on this programme, do not miss this. The former Fed Vice Chair, Richard Clarida, he said last year this Fed would be willing to accept 2 point something on inflation. Are they willing to accept just that? $60 minutes away from the opening bell. Equities doing OK, positive by something like 1/3% this morning on the S&P, up by 1/3% on the Nasdaq. The Russell fading just a little bit. Earlier on this morning was up by 0.7%, now by about 0.5%. In the bond market, 2-year, 10-year, 30-year, the 2-year still in and around 460, 458.68, 422.18 is where we are on the 10-year. On a 30-year, 438.75. If you want some volatility, look to Japan. I'll give you a little bit. 151.97 was the session high. Apparently that's the line in the sand for a bit more verbal intervention from Japanese authorities overnight. We dropped back down to about 151.27, negative by 0.2%. A slightly stronger Japanese yen. That's all verbal intervention this morning, Lisa, has bought them.
I love that you just said slightly. I mean, we're talking about people fading the move that came after Japanese officials said, please stop. We are going to intervene. We're going to do something. And people said, nope, we're not going to do it. Because essentially, the Bank of Japan has shown their cards, and their cards are dovish. And that's all that they need to hear.
Show me the something. And make sure that I'm aware that that threat of higher rates potentially is pretty credible. Because based on what we heard last week, you just know what the bigger priority is. And I think that's what stands out for me. The ultimate priority is that we've got this once-in-a-generation opportunity to reset inflation expectations higher, and we don't want to undo that. We're willing to take negative rates away and go back to zero. But if you think we're going to go on an aggressive tightening cycle anytime soon and undo what's taken decades to build, You're wrong. The priority is on something else.
I'm wondering if Japanese finance ministers are getting on the same page as Bank of Japan members, because at the same time that we heard this from the finance minister, we heard this from a Bank of Japan member basically coming out and saying that the central bank must proceed slowly and steadily toward normalizing its ultra-loose policy. They're not singing from the same hymnal that the finance department is.
Yeah, the currency is just not the priority at the moment. In the grand picture of things, the big picture, 151.26 on dollar yen. Under surveillance this morning, fallout from the Baltimore bridge collapse continues. 6 construction workers are presumed dead, but authorities are resuming recovery efforts and conditions improve. Cargo is being diverted to other major US ports along the East Coast. Maryland lawmakers are pushing for an aid package to help rebuild the bridge as President Biden calls on Congress to approve federal funding, which begs the question, Annmarie, how quickly that's going to take.
Well, one is that you have officials on recess, Jonathan, but then, of course, there's going to be an immense amount of pressure for them to secure funding, to rebuild and help this port. Kayleigh was just in a gaggle with Governor Westmore, and she wrote to me that what he's talking about is that he's working with state government and federal congressional delegation to make sure that they are able to get that funding and also support those Maryland workers that rely on this dock for support. And if that dock's going to be closed for a while and that port's going to be closed, you're going to have an issue of this local economy.
Look for more reporting from Kenny Lyons throughout this morning. Our next story from the FTC. They've been investigating TikTok over alleged faulty data security and privacy practices. Politico reporting that the agency could decide to bring a lawsuit or settlement against the platform in partnership with the DOJ. FTC officials accusing TikTok of deceiving users by denying that individuals in China have access to user data. The FTC and DOJ are reportedly holding discussions about next steps, including civil penalties. The case is unrelated to the forced sale bill that's now stalled in the Senate, but you imagine the Senate and senators will begin to lean on whatever comes out of this, Lisa, sometime soon.
Exactly what I was going to say. That basically national security was doing a lot of the heavy lifting, and now it's actually doing the entirety of the lifting through the Department of Justice. Is this the avenue that will be the quickest way to get there, given how many hurdles we've talked about with getting through a sale or some sort of divestiture?
You raised the question about Europe in the last week and data privacy. The focus was on Apple and what's happening with Alphabet and all the other tech companies. What's going to happen with ByteDance, with TikTok in Europe too?
Good question. And honestly, how worried are they about the potential data breaches, and how much does the U.S. and Europe get on the same page at a time? Or are there other differences having to do with certain, antitrust issues that Europe has raised about the U.S.?
Senators may now rely on the FTC, but actually this originated from Senator Warner and Rubio in July of 2022, writing a letter to the FTC saying you need to look into this, and now it's come full circle.
Very circular. Everything down in Washington. Let's turn to the Fed speak. Continuing today with Governor Waller, set to deliver remarks at the Economic Club of New York. On Friday, you'll hear from the San Francisco Fed President Mary Daly, speaking ahead of Chair Powell himself. Their remarks coming after the Fed's preferred inflation gauge, PCE, is due out 8:30 Eastern Time on Friday. Bloomberg Economics expecting core PCE to rise the most since September, backing the Fed's patience on rate cuts. I'm pleased to say that we're blessed with the presence of the former Fed Vice Chair, Richard Clarida. Rich, it's good to see you.
And I'm blessed to be here.
Oh.
Thank you very much. I've been singing your praises for the last week because I was thinking back to the secular outlook from PIMCO in the middle of last year, where you and the team wrote down this Fed will accept 2 point something. Can you describe what you were looking for back then, what you saw and whether it's starting to come your way?
Well, John, I think it has played out. Look, I think Chair Powell and the committee deserves enormous credit. Inflation got up to 5.5% or 6%, maybe 10 on headline. It's now running in the twos. Our view then was 2 point something would be the point at which the Powell Fed would start to pivot towards easing. I think they think they're done. I think they're signaling that they're going to be cutting starting this year. I think it's important to remember the goal is to get to 2%, but they're going to start cutting before they get to 2 based upon their view that financial conditions are tight. So we'll see how it plays out. But I think so far that's played out like we thought.
A phrase you've used is opportunistic disinflation. Can you help me explain the difference between what you see and maybe what others see when they start to say things like, and I was talking about it on this program, a higher tolerance for inflation? What's the difference?
I don't think John, I don't think there's the tolerance. Opportunistic inflation actually is something that folks thought the Greenspan Fed did 30 plus years ago. That as you tighten policy, you get inflation close to where you want it, but for that last mile, you just wait till the next recession to get it done. And that could well be what we end up in this cycle. That is, the rate cuts will start before you get to the long run goal of 2%. And at some point, there'll be a downturn. Inflation can fall further then. The tricky thing is, of course, the Fed wants to avoid the downturn in the first place, which means at minimum, Chair Powell will have some communication challenges ahead, I think.
Well, there's a lot to unpack there. Just let's start on the first issue, which is something that Andrew Hollenhorst was talking about earlier this week, that essentially you cannot get down to 2% without a recession. Do you agree?
Well, I think historically that's what you would say. But look, the progress has been remarkable. You mentioned Governor Waller, big fan of Chris's, worked with him. You know, Chris has been making the point you can get back to 2% without a lot of unemployment if vacancies are cut. So I don't want to say that you can't get there, but it could be a heavy lift, yeah.
Well, and the other part of what you said is really important. The Fed doesn't seem to want that weakness. And they even said that they would cut rates in response to a weakening labor market.
I noticed that, yeah.
What does this mean for the longer-term inflation rate? Does it mean that 2-point-something is the floor? And kind of we could see sort of bouts of volatility in inflation in the upcoming years?
I think that is a risk case. I think the progress on disinflation is remarkable, but inflation's still above where they want it to be. And there's some evidence that it may be more sticky and stubborn than folks were thinking. Again, I'll let the data speak for itself. I hope the Powell Fed really is data dependent. I think they need to be open to the possibility that inflation is sticky, and I think that changes their communication and the rate path.
Can you help us understand an inconsistency that we struggled with last week and again on the programme this morning?
Yeah.
We caught up with Bruce Kasman at JP Morgan, who
Yeah.
was brilliant, and acknowledged the difficulty in explaining the following. When the Fed is asked if we're sufficiently restrictive, Chairman Powell will often speak and point to the labour market, then simultaneously embrace and confirm that a lot of the improvement came from the supply side. Now, I'm trying to understand whether you can really point to the labour market as a sign you're sufficiently restrictive and also acknowledge that a lot of the improvements come from the supply side. Can you do those two things at once?
You can. I think, look, there has been improvement in the labor market. Wage inflation has stepped down from 5.5% down to around 4%, but that's still a little bit hot compared to where they want to get. But the chair is right. There's been important supply side benefits, in particular labor supply. Productivity is also picked up. I actually think, John, if I could, I think maybe a little bit more of a disconnect is on the financial conditions predicate itself. If you just look narrowly at the federal funds rate, it's well above inflation. That looks very tight historically. But of course, very few people, including banks, borrow at the federal funds rate. If you look at mortgage rates and you look at other things, they've come down and credit spreads are tight. Bloomberg financial conditions indexes, including Bloomberg's, are easing. And so he got that question last week about financial conditions, and he says, we think they're tight. Well, they could be, but they're certainly easier than they were in November. So,
what do you think he's pointing to when he says we think they're tight? What is he pointing to?
Well, absolute borrowing costs. If you want to get a car loan, if you want to get a mortgage rate, so traditional indicators of the cost of borrowing are elevated, but obviously other indicators are moving in the other direction. So as usual with the data, it's probably a mixed picture.
Do you think that it's clear that it is truly a sufficiently restrictive rate currently at the Federal Reserve?
That would be my base case, but there is a risk that it's not. And I think, importantly, the focus on the baseline, of course, is reinsuring. We want to know what's going to happen. But I think there is a risk management case here where it may not be restrictive enough. I think the Fed's view, I don't think people care what I think. I think the Fed's view is if inflation's stickier and more stubborn than they want, they'll just keep rates at the current level longer, or they'll reduce the pace of rate cuts. I don't really think the Powell Fed is thinking about hiking anymore right now. I think they think they're done.
You said if the Fed really is data dependent, and I don't think you're necessarily casting doubt on whether they look at the data, but what data matters most if what we're looking at right now is inflation data that is coming in hotter, and frankly, goods disinflation that seems to have ended?
Certainly the January and February data, if the PCE comes in, that would be the reason. There is some evidence, and I think the chair is correct, of seasonality. That's always tricky. And in recent years, most of the bad news in inflation has been in the first 4 or 5 months. So I don't think we want to remove that possibility. I just think that a sticky inflation scenario is maybe not a baseline, but it's a very realistic case. And I think investors and people looking at the economy need to start thinking about it.
How do you perceive the balance of risks? Holding too long or cutting too soon? What is the bigger risk for you?
Well, I'm no longer there, so it probably doesn't matter. I think given that the last 3 years inflation has substantially overshot the target. Look, I was a charter member of Team Transitory. It's looking better now than it did a year ago. But I think there is path dependence and history dependence in monetary policy. And so I think the risk management I would be doing if I were there would say there is a real, we want to avoid, we want to avoid having inflation shoot up again and having the credibility challenge. So I would be leaning more in a hawkish balance of risk mode than just hugging the baseline right now.
To put sort of a bow on that point, if you think about how much more investors have to consider the idea of sticky inflation and Fed officials themselves, can you give us a sense of how much that possibility has increased, in your view, in the past month or two based on the loosening of financial conditions and, frankly, the Fed's response to it?
It has increased, certainly. Look, we got 5 out of 6 months of really, really good, surprisingly good inflation data, and for good reasons, both supply and demand. Where in some ways, I think there's actually now, compared to where we were maybe in January, a better alignment between markets and the Fed in the sense that, after the December meeting, the markets had priced in 6 or 7 cuts, which was a disconnect with what I thought the Powell Fed would deliver. So on that end, I don't think there's too much of a disconnect. Now, I think markets understand. They think they're done. The margin that they're going to play with is when to cut and how much to cut, but not to hike. So I don't think there's that much of a disconnect right now.
One final question. Can we do the show again in Newport Beach, California? Can we do that in June?
Excuse me? Well, it's above my pay grade, but and I'll treat you to a burger like I did. Actually, you treated me, or no one treated each other. So.
No, I think we treated each other.
We treated each other.
That was
okay.
it. I think sort of Manny and Mike exchanged cards or something like that. Rich, it's good to see you. Thank you, sir. Thank you very much. The former Fed Vice Chair, Richard Clarida. Equities right now on the S&P 500, Lisa, positive by 0.4%.
Let's get you an update on stories elsewhere this morning. 6 people are presumed dead after the collapse of Francis Scott Key Bridge in Baltimore. President Biden saying he wants the federal government to pay for the rebuild, with the governor of Maryland telling reporters it's critical they act quickly.
This is not just impacting Maryland. This is impacting that farmer in Kentucky. It's impacting that auto dealer in Michigan. And so it is imperative that we get this bridge rebuilt. It's imperative that we get the Port of Baltimore back up and going. And it's not just about how are we supporting Maryland. This is about how we're supporting the American economy.
Meanwhile, Brent could hit $100 this year if Russia's decision to cut production isn't balanced out by other countermeasures, this according to analysts at J.P. Morgan. The bank saying the actions could see the price of oil hitting $90 next month and close to triple digits by September. Russia saying its decision to deepen its production cuts were based on expectations for global oil demand growth. Trump media and technology continuing to surge in pre-market trading. The stock ending the day 16% higher after rising as much as 59%, I should say, on his first day public yesterday. The stock adding to the former president's net worth on paper. Trump's 60% stake may now be worth more than $6 billion based on SEC filings. However, Trump cannot sell his stake immediately due to a 6-month lockup agreement, which raises questions, John, about whether this is actual wealth, whether this is paper wealth, whether he can cash out, what this means. All I know is that to short that stock is incredibly expensive, and a lot of people are piling in.
Yeah, very risky, I'm sure, as well.
On every level.
I think the real date on the calendar you should look for is maybe not the end of the 6-month lockup. Get back into power and sell it tax-free, right?
Is that what you are on this tax?
That's what I would do if I got back into office.
The tax mitigation policies that you find interesting.
Absolutely.
Sort of like Jamie Dimon.
That's the last remaining attractive thing about working in Washington.
Is this your pitch to people?
In the US
This is why executives should do it.
I can't think of another reason why
incredible.
You'd want to go.
How about
he
oil
might
service?
Need to cash out to get that money so he can
borrow
actually
against
become
it.
president.
That's so cynical. What about serving the great country?
Yeah. How many people want to do that now, given what's happening in Washington?
Jamie Dimon.
Think about the message that has come from the people who have left in the last week. We had a Republican recently who talked about messaging bills, how he was sick of it, you can't get anything done. Go back and listen to what Mike Gallagher had to say, and I think that's a sad indictment of how people feel about serving in Washington at the moment.
I really would like to get back to an era, especially not necessarily the high level, but rank and file, where it is something of an honor. And that's all that we all can hope for.
Here. I'm with you on that point. Up next on this program, EV makers facing demand pressures.
In terms of the EVs, the growth is there in the market. Perhaps the consumer moving into the EVs is at a slower pace than what some had dreamed about. But the growth is there, the interest is there.
That conversation up next. The opening about 42 minutes away. Equities doing okay on the S&P 500. Positive through most of this morning by around 1/3 of 1% to about 0.4 of 1%. Under surveillance this morning, EV makers facing demand pressures.
In terms of the EVs, the growth is there in the market. Perhaps the consumer moving into the EVs is at a slower pace than what some had dreamed about. But the growth is there, the interest is there, consideration is growing, and once people have driven EVs, they are very loyal to that type of powertrain, and so we think we will be seeing a steady growth in the market.
Here's the latest this morning. Growing EV demand concerns are forcing automakers to scale back production, with some making a pivot to hybrid vehicles. In China, shares of BYD falling in Hong Kong, trading after the EV maker's earnings missed estimates amid aggressive price cuts. Competitor Volkswagen saying it expects to fall behind in China. Quote, along with our value over volume growth strategy, we are deliberately prepared to give up market share in order to find a sound compromise between margins and volume. For more, Pablo Nissi, Volkswagen Group of America President and CEO, joins us now. Pablo, good to see you.
Good morning.
Thank you for coming into the studio. I know it's an important couple of days for you and the team here in New York City. I just want to reflect on the events of yesterday in Baltimore, important hub for automakers. Can you walk us through the potential disruptions for you, the team, and the company?
Yeah, first of all, regarding yesterday, our heart goes to the families. Yeah, it's quite unfortunate that everybody's looking at this. From a business point of view, we are on the side of the sea level. So, you know, when the ships come into Baltimore, we're not going to be affected by this event. Obviously, we're going to have some disruption because of the trucks, but it's not going to be as disruptive as other automakers.
Supply certainly hasn't been the problem in this industry. Unfortunately, it's been demand. Can you walk us through where you're seeing things weaken, where you're seeing things strengthen, and whether you're able to lean into what's happening with hybrids and the demand for it in America?
Absolutely. So let me start talking about the industry. February year to date, the demand is very strong as an industry. The North American market, which is Canada, US, and Mexico, grew 8% February year to date versus last year. And we grew 21%. So we're tripling the growth of the market. But still, 8% is quite strong. And what we're seeing, the data from March, is still strong. Having said that, the EV has flattened. The curve remains around 7.5%, 8% of the total industry. But we as VW, we still have 12% of our sales are in the ID4, in the electric vehicle space. So we're still having higher growth than the average market.
Do you expect to ramp it up, though, more slowly and maybe put a greater emphasis on hybrids? Are you starting to sort of sow the seeds for that right now because you have a couple of years or potentially months to really get that up and running?
Yeah, so our factory is highly localized in the U.S., and we have both combustion engines and electric vehicles in Chattanooga, in Tennessee. And we're the only foreign automaker that qualifies for the $7,500 credit for the consumer, which means that we're localized within the region. So that gives us our flexibility. Going forward, I think the pace of growth will be slower, but we'll still grow in the EV space. And other powertrains will be a good alternative for the consumers. So the consumers will be able to choose electric vehicles, plug-in hybrids, and combustion engines.
How important was that subsidy to you, to not only build a factory, but also just in terms of your decision of the product mix to sell?
Well, first, I think the IRA, the Inflation Reduction Act, is a great piece of legislation for the U.S. because it is transforming the industrial base of the U.S. So you see all these new factories and battery factories being built in the U.S. over the next 3 or 4 years. So the benefit is not only for us, but also for the consumer. You know, by the fact that we're localizing and we're bringing all the jobs of Volkswagen and also the suppliers, you know, we create an ecosystem that provides more jobs here, and then the consumer gets a $7,500 credit.
If Trump were to come back in power, though, he can rewrite those Treasury laws, which makes a subsidy, which could make the subsidy basically impossible to get. How are you thinking about that kind of impact when all this money has been put towards the EV market?
Yeah, so we have a long-term vision on these topics. I mean, we know that, and we believe we remain committed to the EV strategy in the long term, and the pace will depend on the consumer. Now, is it possible that the rules will change? It's possible, but he would need a vast majority in the Congress and the Senate to change his laws. And also, when you look at the map where all the factories are being built, they're not built only in states that are Democratic or Republican. They're being built all over the U.S. I think, in the interest of jobs and growth in technology, I think it would be wise to maintain this long-term vision.
Do you think it would be wise to wait until after the election before you make decisions about your manufacturing footprint in this country?
I don't think so. And I'll give you an example. And these are not only words. We decided to localize the ID4 way before the Inflation Reduction Act, which goes back to your question, right? So we believe so much in the transition to electric vehicles and in localizing our footprint in the U.S. that we made decisions before and after that we're going to continue to localize.
One push over the last year or so by this president, by this White House, is to push and support union workers. You mentioned Chattanooga. At that plant, there's going to be a vote on whether the workers join UAW, that specific union. Can you walk us through what that could do to your cost base?
Yeah, first of all, we respect the freedom of our workers to choose how they're represented. Having said that, we're constantly talking to our workers on how to improve the working conditions, the salaries, and the benefits. It will be up to them how they want to be represented in the future. So we will respect that.
And the cost base? Would you just assume it would increase off the back of that?
I'm not so sure. I mean, we have a very competitive cost base, competitive in terms of the employees. We have wages around $23 an hour, which are comparable to Michigan with a lower cost of living. So we will see.
Pablo, thank you, sir. Hopefully we can catch up again soon. Appreciate your time.
Thanks for the invitation. See you next time.
Pablo de C, the VW North America CEO. Let's set up tomorrow. Tomorrow, this is what the programme looks like. We'll catch up with the Kia COO. The conversation around automobiles will continue. DHL Supply Chain CEO Oscar de Bock will join us too. The Merck CEO, Robert Davis, and Tiffany Wilding of PIMCO. A lot to get into, Bramo, regarding industry and global business.
Especially at a time of so much change. And really what we've been hearing is consistency is all that really matters. And that, going forward, that they can adapt to any possible shift as long as there's some consistency.
The opening bell about 35 minutes away. Equity futures near session highs, positive by almost 0.5%. From New York City, this was Bloomberg Surveillance.